welcome you on the behalf of ICSI IIP.
Thank
Ma'am
you.
is Company Secretary, a registered insolvency professional, and a designated partner in Kanjan Co. LLP Pune. She has a vast experience of over 22 years. Her area of practice includes corporate law, IBC, shareholders dispute, corporate restructuring, and appearing before NCLT and NCLAT. Ma'am is also an independent director and act as an external member in the Internal Complaint Committee formed under Prevention of Sexual Harassment and Workplace Act. Ma'am, I welcome you and you may please begin with the session.
Thank you so much, and thanks to ICSI IPA for having me here today. It's always a great chance to interact with fellow professionals and exchange views. So thank you for having me here today. And good afternoon to all. Good afternoon to all the participants. The topic which we are discussing today is the related party transactions, which is of great interest to everybody, and a lot of things are there to discuss. So what I propose to do is I have certain comparisons in the definitions of related party in different acts, like the IBC, the Companies Act, and so on. And then a brief discussion on the provisions of the of related parties in Companies Act as well as in IBC. The concept of avoidance transactions, which I have been asked to cover in this. Also, the concept of arm's length pricing. Then the concept of ordinary course of business, which we know are the exceptions for the related party transactions. Some case laws on that, the PUFE transactions in detail, and section 21. So role of related parties in the committee of creditors. So I've been asked to cover these topics. We have 4 hours, so I think we should be able to cover most of these. But if not, then I'll be circulating the case law. So I've prepared a compilation of the case laws. In case we don't have sufficient time, then I can circulate the case laws, which I've tried to compile on these different topics. I hope my screen is visible. The screen is visible, right?
Yeah, it is visible, madam.
Yeah, thank you.
You can go ahead.
Thank you, sir. Okay, so the topics which we are covering today is the concept and evolution of the related party, comparison of the definitions, then the relevant concepts along with it, the related party transactions, the concept of ordinary course of business, arm's length, and the avoidance transactions. So we all generally understand what related party transactions are. So any transactions which are entered into by a corporate entity with its related parties. And in that, we also need to discuss what is the treatment to be given to such transactions, especially in the context of avoidance transactions of a corporate entity which is undergoing CRP, or which is likely to undergo CRP, or which is the imminent threat of insolvency. Related parties also have the being internal people or having access to different kinds of information in the company. They are likely to have superior information relating to the company's affairs, the financial affairs especially. This kind of information, which is kind of an inside information, may be used to divert the assets of the company from its creditors and the stakeholders in the period leading up to the insolvency. So even though it may not be immediately after the insolvency, of course, we come into the picture, and then the control of the transactions is with us. But even before it starts getting into the insolvency period, even before maybe all the defaults start happening, which is the period which is known generally as a twilight zone, what we understand. In that period also, certain transactions can be entered into by the directors or by the management, which will lead to a diversion of assets from the entity, and which is something which we need to look into in our transaction audit, what we do under the Act. Of course, the idea under any action which we take under the Act is to maximize the value to the creditors or to other stakeholders, and to try to regularize the transactions, try to bring in that value which has been eroded, that may be able to be brought into the company, so that it can be distributed to the creditors and the stakeholders in the course of the CRP proceedings. So this is the intent behind having these identifying these related party transactions, and of course going ahead and entering into this transaction audit and other things. But before we reach there, let us understand who is a related party. We all are aware of the definitions under different laws, but I've tried to make a comparative chart so that it becomes easier for us to understand who is a related party under different acts, and is there a difference between these definitions. So this, I've tried to make a comparative chart. So first is the first column is the definition of a related party in relation to a corporate debtor. So which is 5 subsection 24 of IBC. Then we have 524A of IBC, which is a related party in relation to an individual. Then the third column is the definition as per the Companies Act, a related party as defined in the Companies Act, and the explanation as per AS 18. So let us look at the definitions in detail. So under 524 of IBC, a related party in relation to a corporate debtor means a director, a partner of the CD, or a relative of a director or partner of the CD. As compared to that, under Companies Act, if we look at it, the people covered here are a director or his relative. So if we look,
Madam,
yes,
may I intervene?
yes, sir.
Could you also add income tax related parties so that we could look at all the things in one go in the chart?
I don't have that readily available, sir, but then maybe, if time permits, then maybe at the end, in the second half of the session, we can discuss that. That I don't have added here as the
Relevant income tax act for this purpose.
Yeah.
So that's,
yes.
thank you.
Okay, so here we have the related party is a director or partner of the CD, a relative of a director or partner of the CD, then a KMP or a relative of the KMP of the CD. So if we are looking at the related parties in the first column only, then a LLP or a partnership firm in which a director, partner or manager of the CD or his relative is a partner.
Madam, KMP, do you have a definition?
The KMP is not defined in the code, but KMP is, as we understand, the key managerial personnel, which is defined in the Companies Act. The IBC does not define the term KMP. But as we understand, under the Companies Act, the KMP would include the CEO, CFO, the managing director, the company secretary, the CFO, under 203 of the Companies Act. Then point number 4, which is a private company in which a director, partner or manager is a director and holds along with his relatives more than 2% of the share capital. So both the conditions need to be satisfied here. Is that the person should be a director and should also hold at least 2% shares along with, individually or with his relatives. Here, what we need to note is that a private company in which a relative is a director, such a private company is excluded. So only the private company in which the person himself is a director and holds 2% shares is covered. But where the director is where a relative is a director, that kind of private companies are excluded here. Then the next is, again, the other point to be noted is that the holding of shares is mandatory because it's a and condition. So only just being a director or only holding the shares will not make it a related party. Both the conditions will have to be satisfied. Point number 5 is a public company in which a director, partner or manager of the CD is a director and holds 2% along either by himself or through his relatives. Again, here the public company in which relative is a director is excluded and holding of the shares is a mandatory condition. Then point number 6 is something on which there can be a lot of litigation and something which we need to understand differently. Is any body corporate whose board of directors, managing director, manager in the ordinary course of business acts on the advice, directions or instructions of a director, partner or manager of the CD. So proving this when we are doing the transaction audit is we need to be treading very carefully here, because what we are trying to show is that any body corporate whose board of directors, the MD or manager is used to acting on the advice or instructions of the director, partner or manager of the CD. So typically what we should understand is if there is another body corporate which has a board of directors in place, then by virtue of the provisions of the Companies Act, it being a separate legal entity, the board of directors is a separate body which is available to run that company. And then to allege that that board of directors is acting on the instructions of a director of the CD, we really need to have sufficient evidence, or we really need to have sufficient documentation in place to be able to show that actually that board of directors is just a paper or somebody who doesn't have the powers actually to run that company, but it is being done on the instructions of the person who is sitting on the board of the CD. So there we need to be able to have sufficient material in hand to be able to put any company or classify any a related party, a body corporate as a related party under this particular clause. Then point number 7 is any LLP or a partnership firm whose partners or employees in the ordinary course of business act on the advice, directions or instructions of a director, partner or manager of the CD. So here again, similarly, the first case was of a body corporate. Now this is a case of a LLP or a partnership firm whose partners or employees act according to the instructions of the corporate debtor or any of its directors, partners or the managers. Here
Madam,
again,
can I take one question?
yes, sir.
See, there are shareholders who by de facto, they control the company. But
Yeah.
due to these provisions, they step down from the directorship well in advance. They know that, that company is not going the right direction. So they step down. They put dummies, even drivers, cooks, whatever, whomsoever they get on their hand, they put in as the directors, they step down.
Yeah.
What is the, how do we establish that these cases and what documentation would suffice?
So in my view, if we see that this person is a driver, so we can easily put that case under point number 6, because we can say that even though this has a separate board of directors, which comprises of maybe the peons, the directors of the corporate debtor. So maybe there's a director X in the corporate debtor. His driver Y is sitting on the board of this other entity, and there are a lot of transactions which have taken place among the two entities. So it is very once we understand that that person Y is a driver of X, and he himself does not have maybe the professional credentials, or he's not actually taking the decisions in the board of that other entity, then it becomes easy for us to show that this is only a sham entity. And this person has been totally acting, he is in the employment of this X. So he has been acting on the instructions
will it be
of this
in
person.
in that case, can we move away from the directors, go to the shareholders?
Yeah, we have to leave the corporate will in that case, because we are saying that this other body corporate is acting in the ordinary course of business, is acting on the instructions of this particular director X, who is on the board of the CD. So the transactions which have been taken,
there is no, he doesn't hold any directorship very sensibly. It's a very same body corporate. He steps out and he becomes only the shareholder.
I understood what you are saying.
That the shareholders relationship and his, if he's a bank, if he's signing the bank document, at least we can consider. So otherwise, how do we do that? It's going to be the task.
Yeah, that's what I said. So that person need not be a director there. Even if he, as you said, he's a driver and he's sitting on the board of that company. So this director of the CD, he has stepped down from that company, and he may be only merely a shareholder, or he may not even be a shareholder. So somebody as his proxy is sitting on that board of directors, right? That is what you're saying.
Yes.
Yeah. So then it becomes, we say that this is a driver who is sitting there on that board, who may not even be a graduate. So how is he running that company? So we have to lift the corporate veil over there.
We are taking the easy example of a driver. Maybe they are smart. They will put you on educated people, staff as that.
You gave the
they
example
are
of a
shareholders,
driver.
but they are controlling. So in that case, how do we do that? Shareholders instead of a director, do you have a provision?
Instead of
they are shareholders. They are running the company, but
so who takes a decision in the company? The board of directors takes a decision in the company. Not everything goes to the shareholders.
There is a director, but there is a director namesake who will do all the signature, all the things, whatever that shareholder says.
Sir, the decisions in a company are taken by the board of directors. Majority of the decisions. Only there are few decisions for which we need to go to the shareholders. Now the shareholders.
Unfortunately, the directors are dummies. Only the shareholders are the de facto running, but with the conduit that, they know that directorship gives the liability, so they keep away from the liability. They take care of this so-called directors adequately, so they sign wherever they need to be signed.
Exactly for that particular position, this point number 6 is introduced, right? That is what we are discussing. Any body corporate whose board of directors, MD, manager, by whatever name called, in the ordinary course of business is acting on the instructions of the director, partner or manager of the CD. So this other company,
Madam, you are not understanding. They are not.
So can we move on? Maybe it will get covered in this. I think
please.
we are just having a one-on-one.
He has raised an interesting question. So this other gentleman, what he is saying is neither a director nor a partner or a manager.
Yeah.
He is simply controlling by virtue of his.
So there are other clauses in the definition. Let us finish the other clauses,
Sure.
right? Yeah, let us not get stuck only over whether he's a director or shareholder.
Sure, we'll wait. But this is not the provision which is covering.
No, this is not the provision. There are other clauses there in the related party definition. Right. So the point number 7, any LLP or partnership firm whose partners or employees in the ordinary course of business acts on the advice, directions or instructions of a director, partner or manager of the CD. So here again, something similar to what we saw to the body corporate. This talks about LLP or a partnership firm whose partners or employees are acting on the instructions of the CD. So anybody from the CD is giving those instructions, and then it becomes simple to show that these people are acting on the instructions of the CD. Point number 8, any person on whose advice, directions or instructions a director, partner or manager of the corporate debtor is accustomed to act. Now, in this case, it need not, that person who is giving the instructions need not be on the board of the CD. He need not be even a shareholder of the CD or be related in that sense. But if we are able to show from the transactions that the directors, the partners or managers of the corporate debtor are acting on the instructions of this particular person. So that person may be an individual or a person as may be defined in the General Clauses Act. So it need not be an individual only, or it need not be a company. So any person on whose advice, directions or instructions a director, partner or manager of the CD is accustomed to act. Here this will also include any person, say, who is the patriarch of the family, who is no longer even the chairman, he has stepped down, or somebody who is like a Benami investor. All those people will get covered in this, provided we are able to establish that there have basically transactions, whatever have been entered into by the corporate debtor with this with any other party, that the actual driving force behind the company entering into these transactions is this person, who may not have any official position in the CD, but everybody is acting on as per his instructions. Now, this is something which is very maybe a fact specific, depending upon the facts of each case. So we really have to go into the transactions, really need to understand.
This my question.
Yeah.
This covers my question.
Yeah.
Incidentally, how do we take it? Do we have to go to the legal means of proving it? Do we have any easier method of using this provision?
So I
do you
would
have
say,
any practical exposure?
Yeah, so I would say that this would depend upon the facts of the case, because this clause number 8 is extremely vague, and I think it can cover anybody under the sun, be it an individual.
No, I have told you in my case, most likely these are shareholders or their relatives who are controlling. So we should go to the NCLT in this case, right?
So we will have to classify, first identify that this is a related party based on the transactions, then identify it falls under which section of, which of the transactions, like 43, 49, 47, 66, whichever it may be. And based on that, if it also falls into that transaction, then it will be identified, it will come under your PUFE, and then you can file that application to the NCLT. But just by virtue of being it being a related party, and if these transactions which you have entered, it will have to satisfy both the tests. I mean, one of being a related party and other of being a related party transaction. I hope I was clear.
Yeah, you are clear, madam. Thanks.
So point number 9, a body corporate, which is a holding, a subsidiary or an associate company of the CD, or a subsidiary of a holding company to which the CD is a subsidiary. So it means, in short, means a fellow subsidiary. So this category covers any body corporate which is a holding subsidiary or an associate company of the CD. Now here we have this definition in the similar definition in the Companies Act also, but there we harp upon the word company in the definition. So we take only the companies which are under the Companies Act, who are registered under the Companies Act, and who are basically Indian entities. In the case of related party under 524, we should go one step beyond, because it says it's a body corporate and which is a holding subsidiary or an associate company of the CD. So we can go even reach out to the entities which may not be Indian entities, which may be registered under different jurisdictions, but the transactions which are coming, which have been entered into with these entities, may be covered in our PUFE if we are able to establish the relationship that's a related party. Now, any person who controls more than 20% of the voting rights in the CD on account of ownership or a voting agreement. Now, it could, again, this could be an individual, it could be an entity, it could be a body corporate, any person. who controls more than 20% of the voting rights in the CD on account of ownership or a voting agreement. So he may not be on the board, he may not be issuing instructions about the management of the company or the day-to-day affairs or taking decisions, but he is controlling more than 20% of the voting rights of the CD by virtue of an agreement which was entered into between the CD and this person. So any investment agreement, the SHA, SSA, anything which could be there. So we need to look at all these agreements which will be available in the CD. And if we are able to identify such a person, then such a person may be classified as a related party. Only thing what we need to see is that is he actually controlling the voting rights? Because there's a case which we will discuss when we are discussing the case laws, was where that person had given a loan and which was that amount was to be converted into equity at a later point in time. But actually, when the transaction was being reckoned, when the RP was going through the transactions, he had not acquired the voting rights. It was a future right which was going to accrue. So that the NCLT has held that since today the person does not have voting rights, he cannot be treated as a related party for the purposes of this code as on that particular date. So we need to be sure that this person has actually acquired those voting rights under that agreement. Any person in whom the CD controls more than 20% of voting rights on account of ownership or a voting agreement. So the reciprocal kind of a thing where the CD is holding more than 20% in some other entity by virtue of voting rights or by virtue of that agreement. By virtue of ownership or by virtue of that voting agreement. Then any person who can control the composition of the board of directors or corresponding governing body of the CD. So this again need not mean some shareholder, it can be somebody else who is calling the shots and who is able to control the composition of the board, or maybe the designated partners in the case of a LLP. Such a person can again be an entity, it can be an individual, it can be a patriarch of the family, it can be some other person who is an investor but who is not there on like a Benami investor who is not on paper. Any such person will fall in the category of the person under point number 12 who can control the composition of the board of directors. So somebody like the example which sir had given, somebody where there are only drivers or somebody else in the other company. So we can clearly see that this person is calling the shots and he is controlling the composition of that particular entity. Then this last one, point number 13 is something which is very, very generic, and we can fit a lot of transactions into this, provided we have sufficient grounds or we have sufficient material on hand to show that this is actually what the case is. So any person who is associated with the CD, you see the words which I used, any person who is associated. So person will again include individual or any other type of entity, and who is associated with the CD. So again, association, it is what we understand in the common parlance. It does not carry a specific definition in the code. So any person who is associated with the CD on account of, participation in policy making processes of the CD. So somebody who is helping the CD, not in a professional capacity, of course, but somebody who is helping the CD make the policies for the day-to-day management or policy decisions as regards the investments or those things, so major policy decisions. So any person who is associated or participating in the policy making processes of the CD will be treated as a related party. Any person having more than 2 directors in common with the CD. So here the question of shareholding does not arise. So the previous 2 points where we had seen was it was a private company and a public company where the one director was common and there had to be a 2% shareholding also. But in this case, here we are having more than 2 directors in common. The shareholding is not required. So even though that person is not holding a single share, but just by virtue of having more than 2 directors in common, such a person will become a related party to the CD. Then interchange of managerial personnel between the CD and such person. So if we have a case where there are group companies, and even though on paper there may be no common directors, there may be no common shareholders, or it may not be falling under any other category, but interchange of managerial personnel between the CD and such person. So if we are able to show that the accounts team is common among, say, the group of all the entities, or the admin team is common, or certain people are working here as well as they are working here, even though they may be drawing salary only from one entity. But if we are able to show that there is an interchange of managerial personnel between the CD and this person, then even that other person will be treated as a related party. Now, all these things are actually extremely fact specific, where we will have to actually go and see what is the working of the CD. We will have to see what are the nature of transactions of the CD with these entities, even going beyond the look back period, because you might find something under 66 or those fraudulent transactions are, so which will go beyond the limitation period of that 1 year or 2 years. And if we need to understand what is exactly the nature of the business. We need to understand what is the type of activities which the CD is carrying on, not only as regards its main business, but in terms of its administration, as in who are the employees, what all are they doing, if it's a going concern, of course, what all are they doing currently? Are they only working for this particular entity, or are they working for any other entity also? Or are the employees of any other entity also working for the CD? So we really need to go and sit and understand the working, maybe the organization chart of the CD, understand the departments, the various departments, and what each person is doing. And then only we will be able to arrive at the conclusion about any person falling in this category. Otherwise, just on the face of it, maybe there is no common shareholding, there is no common directorships. Then we may feel that it's a standalone entity. Even from the financials, we may feel that this is something which is does not fall under the related parties because there is no common shareholding or those kind of things. But then the IBC definition goes way beyond what we see in the Companies Act. The Companies Act does not have these similar provisions. It only depends, it only looks into the financial transactions which have been entered into between two related parties. But IBC goes one step beyond and tries to get beyond what is only written in the law. We need to go and actually see the functioning of the CD to be able to arrive at any reasonable conclusion. Because see, ultimately, once we arrive at a conclusion that this person is a related party, then we need to go, the next step is to go and examine all the transactions in the last 2 years at least before the ICD. In that course, the next step is, if we actually find out those transactions, then we need to file an application to the NCLT under the appropriate section. There we are required to prove that yes, how this person is a related party and how these transactions are falling under the related party transactions as envisaged here, and why they need to be set aside either under 43 or under 49 or whatever relief we are asking. So there we need to be really sure that this person is going to fall under this category, and this is the supporting which we can collect while we are doing our examination once we take charge of the CD, when we are understanding the affairs. So it becomes really important that we have that sufficient data. Else one is either we may lose out on some transaction which is there, which is actually a person which is a related party, but we have not included him in the list of related parties. And second case could be where we are unnecessarily including somebody as a related party. Now, those people are obviously going to get a chance to file their reply and everything in the NCLT. So that time we should at least have a reasonable ground to make the NCLT believe that yes, this person is a related party under this clause because of these reasons. And in some cases, if we don't identify certain transactions as related parties, then we know under the various provisions, the creditors have a right to approach the NCLT. And at that time, it may become a problem for us that why were we not able to identify this transaction if the creditor has been able to identify that transaction. So this is something which is like what we need to be really careful when we are identifying somebody or saying that somebody is not a related party in this case. Now, point number 4, provision of essential technical information to or from the corporate debtor. Again, this is something which is maybe somebody is using certain common software, or they are using certain common some entities which are there, or some outside service providers who are giving the similar kind of services to both the entities. But in that also the CD has a role, or that other person has a role to play as far as the CD is concerned, in providing the essential technical information by the CD or to the CD. So all those cases will get covered. Again, this will be very case specific.
Madam,
And
just to take a break here again, this is outsourcing concept is very prevalent, and mostly even like the fraternities, our own fraternities work on this field. So how do we handle it? If it is professionally managed, then if they are restricted only to certain transaction recording or representation to the taxation authorities, there we leave it, or how do we take it?
So we should ideally leave it, because if that person is acting in a professional capacity and we can see on the face of it that there is no other interest which that other person also has in the CD apart from providing these services, then there is no need to include that such a person in the related party. I think we need to go into the contract. We need to see not only what is written in the contract, but actually what that person is doing, because we will have to not unnecessarily include him there if he's doing something.
But we have to include him as a related party, but the transaction he doesn't have anything, then we leave it. That's how we.
So I would say that we may not include him in a related party also.
Include it itself, okay.
Because if he's only providing the essential technical information to or from the CD, he doesn't become a related party necessarily because of that. He may be doing something only in a like us, for example. If you are providing services to certain clients, we are doing it in a professional capacity. We don't become related parties there. Okay, so this was about 524. Each clause of the related party. Then we look at 524A, which is a related party in relation to an individual. Now here we were talking as a related party of the CD. Now we go to the next step, which is 524A, which is related party in relation to an individual. So it means a person who is a relative of the individual or a relative of the spouse of the individual. So both categories are covered, a relative of the individual as well as a relative of the spouse of that individual. Then a partner of the LLP or a LLP or a partnership firm in which the individual is a partner. So here the relative is not covered. So any partnership firm or the LLP where that relative is a partner is not covered. Only a partner of a LLP or a LLP or a partnership firm in which that individual is a partner, then that LLP will become that related party of that partner. A private company in which the individual is a director and holds along with relatives more than 2% of its share capital. Here again, the private company in which the relative is a director is included, and again holding of the 2% shares is a mandatory condition. Similarly, for the next clause, public company in which the individual is a director and holds along with the relatives more than 2% of the paid up capital. It should be a public company, but the relative public company where the relative is a director is excluded, and again holding of the 2% shares is mandatory. Any body corporate whose board of directors, MD, manager in the ordinary course of business acts on the advice, instructions or directions of this particular individual, that body corporate will be a related party. A LLP or a partnership firm whose partners or employees in the ordinary course of business act on the instructions of that particular individual. Then any person on whose advice, directions or instructions the individual is accustomed to act. Now here again this becomes very vague. Any person on whose advice, instructions or directions this individual is accustomed to act. Now here we were talking about the director or partner or manager of the CD is accustomed to act. Here directly that person is giving instructions to this particular individual. So then that person will become a related party as regards that individual. Then a company where the individual or the individual along with the related party own more than 50% of the share capital of the company or control the appointment of the board of directors. So with respect to this particular individual, if that individual by himself or along with any other related party own more than 50% of the share capital of that company or controls the board appointment of the board of directors of that particular company, then that company will be a related party as regards that individual. Then a person who is a trustee of a trust in which the beneficiary of the trust includes the individual or the terms of the trust confer a power on the trustee which may be exercised for the benefit of the individual. So that trust will also become a related party where this person who is the trustee of the trust in which the beneficiary of the trust includes that individual, or this individual is able to I mean, the terms of the trust confer any power on the trustee, which may be exercised for the benefit of this individual. So this beneficiary under that trust is this individual. Then that trust will also become a related party. But in other cases, that trust is not covered anywhere else in the other definitions. Now we come to the definition of the related party under the Companies Act. So as per the Companies Act, a related party with reference to a company means a director or his relative, a KMP or his relative, then a firm in which the director, manager or his relative is a partner, a private company in which a director or manager or his relative is a member or a director. So here the minimum 2% shareholding criteria is not there. So even holding one share will trigger this particular clause for that other private company to become a related party, and in which that director or manager or his relative is also covered here. So in the for 524, that relative is not excluded, but here even the relative, even if the relative is a director or a member, even that will get covered, and even holding one share is sufficient in his own name. Here similarly, a public company in which a director or manager is a director and holds along with his relatives more than 2% of the paid up share capital. Again, the public company in which the relative of a director that is excluded, and holding of that 2% is mandatory here. So for public and private, there is a difference here. Even holding one share will trigger this particular clause, but here minimum 2% shareholding is required for the definition under the Companies Act. Now, any body corporate whose board of directors, MD or manager is accustomed to act in accordance with the instructions or directions of a director or the manager, and nothing shall apply to the advice, directions or instructions given in a professional capacity. Now here when we are talking comparing the two definitions, otherwise both the definitions are almost the same, but what we have in the Companies Act is that the instructions and directions given in the professional capacity are not to be considered as a related party for the purpose of Companies Act. Whereas when we are trying to fit something under clause 6 under the IBC, this professional, that exception for the professional capacity has been removed. So in case there is reason to believe that even though this person is actually a professional, but he is calling the shots there, then we may still be able to include that person in the related party definition. 8.1, any person on whose advice, directions or instructions a director or manager is accustomed to act. Now again, any advice given in the professional capacity is excluded. Any body corporate which is a holding, subsidiary or an associate company of such company, a subsidiary of a company, holding company to which it is also a subsidiary, that is a fellow subsidiary, and an investing company or a venturer of the company. So all these are also treated as related parties for the purpose of Companies Act. And such other person as be prescribed, and in the rules what is prescribed is a director other than an independent director or the KMP of that particular company or KMP of the holding company or his relative with reference to this particular company. So a director other than an independent director, so the independent director is excluded from this definition, or a KMP of the holding company or his the relative of the KMP with reference to this particular company. So all of them are covered in the as regards the Companies Act. Now definition of the relative, again in the explanation under 524A, there is an explanation which defines the term relatives, like who all are covered under the definition of relative under the 524A, and a comparison of that with the definition under the Companies Act, like who all are covered under the definition of relatives. Under the IBC, like we can see, the definition is much wider, and it covers a lot of many relations which used to be covered in the Companies Act of 1956, but under the new definition in 2013, that list of relatives was curtailed. So all of them are there in 524A. Members of the HUF now here we are looking at the definition of relative as regards 524A. Then the husband and wives are relatives. Father is a relative, mother, son, son's wife. Now son's daughter and son. Now most of these are here covered in the Companies Act also. Only thing is that the IBC does not talk about stepfather, stepmother, stepson, which is explicitly given under the Companies Act. So here you have members of the HUF, then you have husband and wife, both are common there. Under the IBC, it is father who becomes a relative. Under the Companies Act, father including the stepfather. Same for mother, same for son. Son's wife is common. Son's daughter and son are not covered under the Companies Act, but they are covered as a relative under the IBC. Then daughter, daughter's husband, daughter's son, daughter's daughter and son. The brother also includes a stepbrother here. Then the brother's wife, brother's daughter and son, sister including the stepsister are common at both the places. Then the sister's husband, sister's son and daughter, grandson's daughter and son, granddaughter's daughter and son, father's father, father's mother, mother's father, mother's mother, father's brother, father's sister. So all the extended relations what we have, even those relations are also covered under the definition what we can see as under the IBC. But whereas all of these are now excluded from the definition under the Companies Act. So definition under IBC is definitely much wider. So what we can do is what I typically do when I start any transaction audit is I make a list of this like Excel sheet for each of the definitions of the related parties and for the definition of relatives, and for each director maybe try and fill each of this information. Generally, if the MBP1 and DI rate have been taken on record by the company, then we are able to get most of this information from that. But if not, we will have to try to compile this information, because without that, we may not be able to identify the related parties. And some of the transactions might get missed in the audit what we are doing. We may be not covering some of the transactions which we need to cover there, because we are not sure that all the minutes and everything will be updated. So we need to actually have this Excel sheet and try and identify people under each of this category. Now just coming to the explanation under AS 18. So AS 18 talks about related parties. Parties are considered to be related if at any time during the reporting period, one party has the ability to control the other party or exercise significant influence over the other party in making financial and or operating decisions. Now this is further explanation, where we see what is whether these terms are also defined under the Companies Act or under the IBC. So under the IBC, the definition of control and significant influence is not there, but under the Companies Act, the term control shall include the right to appoint majority of the directors or to control the management or policy decisions exercisable by a person or persons. It shall include the right of acting individually or in concert, and directly or indirectly, including by virtue of their shareholding or management rights or shareholders agreements or voting agreements, or in any other manner. So any other manner again is very vague, so we will have to look at the facts of the case. But this includes the right to appoint majority of the directors or to control the management or policy decisions by a person or persons who may be acting individually or in concert, and directly or indirectly, including by virtue of their shareholding or management rights, which may be under SHA or under a share transfer agreement, or by any other voting agreements, or in any other manner, which may be there based on the facts of the case. Then under AS 18, control means ownership, directly or indirectly, of more than 1/2 of the voting power of the enterprise, or control of the composition of the board of directors in case of a company, or composition of the corresponding governing body in case of any other enterprise, or a substantial interest in the voting power and the power to direct by statute or agreement the financial and or operating policies of the enterprise. So if we see the definition under AS 18 is going beyond what is given in the Companies Act. Companies Act talks about voting powers and those things, or power to appoint majority directors. Here it goes beyond that, and it talks about a substantial interest in the voting power and the power to direct by statute or agreement financial and operating policies of the enterprise. So all those things are also covered in the definition which is given in AS 18. And significant influence means control of at least 20% of total voting power, or control of or participation in business decisions under an agreement. And under AS 18, it means participation in the financial and or operating policy decisions of any enterprise, but not the control of those policies. So again, this is very, very fact-based, and it may not be possible to have something very generic under this unless we have certain facts under which we will have to fit this. But even though they may be related parties under AS 18, or under the Companies Act, still when we are dealing with it under the insolvency code, we will have to try and put it under one of these clauses under 524 to establish that it's a related party, and then to establish that that transaction with that particular entity is a related party transaction and also falls under the POF. Now a little bit brief about the related party transactions under the Companies Act. Since it is given in the topic, I have just included some of the the basics of these transactions here. So related party transactions under Companies Act, as we understand, 188 is the relevant section. And what we need to establish that to establish to determine whether something is a related party transaction or not is whether the transaction is a related party transaction, as in which falls under section 188(1), and whether the party with whom the transaction is being entered into, that party is a related party or not. So unless both the conditions are satisfied, it will not be treated as a related party transaction for the purpose of Companies Act. So the transactions generally are, which are defined in 188 are sale, purchase, supply of goods or materials, sale or otherwise dispose of, buying or property of any kind, leasing the property of any kind, availing or rendering of any services, appointment of agents for purchase of or sale of goods, materials, services or property, related parties appointment to office or place of profit in the company, the subsidiary or the associate company, underwriting the subscription of securities or derivatives of the company. So this virtually covers everything. I think everything, including maybe sale or purchase of properties, availing or giving of loans, leasing of any property, any appointment of anybody in a professional capacity, appointment of directors, any transaction which we can think of which a company may enter into. Almost all the transactions are covered.
Where is it written on your 7 list loan, madam?
So availing or entering of any service.
It is not loan.
Point number 4. Yeah, it can be. Yeah, it's a borrowing service, right?
Not sure.
Yeah, so we treat it as a borrowing, which is borrowing is or lending is a service as such. Borrowing is a service.
Borrowing
or lending is a service.
I'm not sure.
Yeah, we treat it as a related party transaction, especially if the company is giving a loan to any other company. It's a lending service, and for which maybe interest is also charged. So it, according to us, it falls under the definition of availing or rendering of any services. So a company can enter into a specified transaction with the related party only after obtaining the approval of the board or the shareholders as may be required. So board approval is necessary for all cases, except which are falling under the exception. But when the transactions go beyond the limits which are specified in the rules, then we need the shareholders approval also. This is just a diagrammatic representation of the related party transactions, where the exception to take this any applicability of 188(1) is where if the transaction is at arm's length and is in the ordinary course of business. Only those transactions we will be able to take them out of the purview of section 188. But for that also we need to discuss what is or we should have something on the record to show that this transaction is in the ordinary course of business and it is at arm's length.
Madam, going back to the question that somebody raised, are you sure that service lending is a service? Because service has to be non-monetary for which a consideration has to be received. If it is lending, then one, it is non-monetary, and secondly, what is the consideration received? Because you are getting repayment and interest on the money that you are lending.
Right.
So I'm little confused between you and what kind of gentleman that he raised, so if you could clarify on that, to my mind, I will concur with him that, service is not, lending cannot be a service because it's first, it's not non-monetary. True. Secondly, the consideration is on the money that is lent.
Right,
whereas,
but I am lending money, this company is lending money to somebody else, which is, why are you saying it's not a service, and why does the service have to be non-monetary?
Ma'am, if you will see the legal lexicon I just brought.
So maybe what we can do is we can take this in the break. Let us finish this.
Yeah, please.
Discussion
your definition maybe is not including all. Maybe something you have left out one line item which we can include it because yours we want to use it. You have done a wonderful job. We want to use it. That's why the questions are being asked. Don't take it otherwise.
No. It's not about taking it otherwise. I'm saying we need to. I have been given a certain task of completing certain items there. And this is something which is very specific. So let us just finish this portion and then we can discuss it. So in the break or something.
It's fine. So basically, it's your 7-line item does not include the borrowing or lending.
Yeah, that is what you are saying. I'm saying it includes, but then we can take that offline maybe once we finish this portion. This 7 items are those which are from 188.1. Okay, so the exceptions like we were discussing is the transactions which are in the ordinary course of business and transactions which are at arm's length. Let us have a brief discussion on what is meant by the ordinary course of business. So again, the ordinary course of business is definition. I mean, it has not been defined anywhere. So whether some activity will fall under the term ordinary course of business or not will depend on the nature of that particular business. For most businesses, it will be obvious whether an activity they carry on is in the ordinary course or not. But for others, we may have to rely on certain definitions, or we may have to rely on the case laws. So again, the business dictionary has defined the term as a term for activities that are necessary, normal, and incidental to the business. These are common practices and customs of commercial transactions. And to decide whether an activity which is carried on by the company is in the ordinary course of business, the following factors may be considered. Now, this has been, this kind of a checklist or this questionnaire has come out of a number of judgments which have been passed by various courts over a period of time. And this is something which can act as a guide for us to understand whether some transaction is there in the ordinary course of business or not. So whether the activity is normal or otherwise unremarkable for your particular business, that is, it features in your systems, processes, advertising, staff training, and all that. Whether the activity is frequent enough, whether the activity is regularly enough, what is the financial scale of activity with regard to the operations of the business, what is the revenue generated by that particular activity, and what is the extent of the resources committed to the activity. Maybe answering these questions will give a fair idea about whether the transaction is a one-off transaction or is it in the ordinary course of business. Of course, this list is not exhaustive, but these are the general guidelines which may be used. Then whether a particular activity is in the ordinary course of business or not would depend on the facts of each case. Rather than trying to understand what is the ordinary course of business, if we try to understand what is not in the ordinary course of business, that may also be helpful. So there are certain citations which are there, which we will quickly go through, which talks about what is not in the ordinary course of business. So this is a Bombay High Court judgment in the of 1949. So in this case, the amount lent by a company to a third party was held as not to be in the ordinary course of business, because the court observed that just because an activity is included in the memorandum, the activity per se does not become an activity in the ordinary course of business. Now, again, this is something which is very specific to this particular case, and we are just trying to read the ratio here. This is something which may not be applicable to other cases, but this is generally what has been held by various judgments. The rationale behind this has been given, so I'll be circulating this. People who are interested can go through it. The Kerala High Court.
Please circulate the entire presentation.
Yes. I'll be circulating this entire file. So in the Kerala High Court judgment, in this case, it was held that even though a sale is made by the company for its business, this sale may not be in the ordinary course of business. And the court has made this observation that the assessee firm, which was registered as a dealer in dairy products, sold away a part of its livestock and replaced the same by fresh livestock. Then the question which arose was whether this annual sale of livestock could be treated as a part of the turnover of the assessee liable to sales tax. And then there is various discussion which has taken place in this. And if we just come only to the underlined portion, then the sale of dry cattle was a regular annual feature and was carried on continuously from year to year by the assessee company. It was not a case of casual or isolated transaction, but constituted act systematically and regularly carried on in the course of business of the assessee firm itself. The sale of the dry cattle was coextensive with the business of manufacture of dairy products. It was in those circumstances that the view was taken by the court that the transaction constituted sales in the ordinary in the course of business activity of the assessee. Frequency, regularity, and volume of the transactions will no doubt be the factors relevant and helpful in determining whether any particular transactions are in the course of business or not. But the mere existence of these factors will not by themselves be sufficient to hold that the transactions are business transactions. So here it was held that in deciding that the frequency, regularity, and volume of the transactions are relevant to decide whether something is in the ordinary course.
In this case, it was decided that it will be treated as a regular transaction or not?
Yes, it will be.
It will be treated.
Yeah. Then the High Court of Madhya Pradesh in Commissioner of Sales Tax and so on. The true test is not whether the selling activity is continuous or repeated, but whether the carrying on of continuous operations is with a view to earn profit. In that case, the question to be considered was whether the sales of unserviceable vehicles and motor accessories by the assessee, which was a transport undertaking, were sales by a dealer in the course of the business activity. The sales had been continuous and large, and it was contended that because of these features, they constituted an activity coming within the definition of the dealer. And it was held that while these features were no doubt relevant for the consideration of the question, they were by no means conclusive, and the true test was whether the selling activity was with a view to earn profit. So here maybe it was held that these were not in the ordinary course of business. Then in A. Ibrahim and Company versus the State of Bombay of 1962, it is held that the test in our opinion is to ascertain whether in the circumstances and on the facts of the case, it can be said that a particular sale is a sale in the course of business of a dealer. If the sale has a reasonable connection with the nature of business carried on by the dealer, then the sale would be in the course of his business. If there is no such reasonable connection between the sale affected and the nature of the business carried on by the dealer, then the sale cannot be said to be in the course of business, and the sales proceeds cannot therefore be included in the turnover. Now, most of these are related to sales tax, whether to include something in the sales or not. Then the Commissioner of Sales Tax versus Hindustan Spinning of 1963. Sale of old machinery by the respondent company has not been done with a view to make profit on the said sale, but only with a view to replace it by new machinery. Old machinery having become unserviceable or less serviceable. Then again, coming to the underlined portion at the bottom, the business of the respondent company was the manufacture of cloth. For the said business, the company had from time to time replaced its old and unserviceable machinery by new machinery. Although such replacements of the old machinery by new may have been necessitated for the purposes of the business of the company, disposal of the old machinery for the purposes of replacing it by new machinery cannot be said to be a part of business of the respondent company. Now, although it may not
it will be a capital versus revenue, madam. It will be a capital. It will be treated as a capital versus revenue.
So this was held to be not in the ordinary course of business. Then we come to the discussion on the arm's length pricing. So as we generally understand, a transaction in which the buyers and sellers of a product act independently and have no relationship to each other is known as an arm's length transaction. The concept of arm's length transaction is to ensure that both parties are dealing in the deal are acting in their own self-interest and are not subject to any pressure or duress from the other party. So what may be considered as being at arm's length is subjective and a question of fact. Usually the transfer pricing guidelines would be a reasonable reference to decide whether a transaction is at arm's length or not. But in cases where that may not be applicable, maybe these cases, the decided case law may be of some use to us. Is the first one is the determination of arm's length price seeks answers to the question, what would have been the price if the transactions were between two unrelated parties, similarly placed as the related parties in so far as the nature of the product, conditions and terms and conditions of the transactions are concerned. So for that purpose, methodology and modalities to compare the results and the prospective domestic laws of a given country have been formulated. So this goes on to discuss about all these other methods and other things which may be used. And the basic thesis is that the transfer pricing legislation is to treat each of the individual members of the commonly controlled group as a separate entity. Transactions between whom are taxable events to be conformed to the economic realities obtaining between independent entities entering into similar and identical transaction at arm's length. Then we have the Maruti Suzuki case, in which an arm's length price, therefore, is the price with which that the transaction would obtain in the open market. So how to determine the transaction price, the arm's length price. Then Serdia Pharmaceuticals case also is there about when associated enterprises enter into a transaction at such conditions in commercial and financial terms, which are different from commercial and financial terms imposed in comparable transactions between independent enterprises. The differences in these two sets of conditions are attributed to interrelationship and between the associated enterprises, and it is this impact of interrelationship between the associated enterprises that is sought to be neutralized by the transfer pricing regulations. So to understand whether something is at arm's length or not, maybe we can some of these methods may be utilized, which is the comparable and controlled price method, the resale price method, the cost plus method, profit split method, and so on. So we need not go into all the details of each of these methodologies, but what we need to understand is if we are trying to put something or categorize something as falling out of 188(1) or not being a related party under the Companies Act, then we need to be able to prove that these transactions are, rather we as in the other side needs to prove here that these transactions are in the ordinary course of business and at arm's length. So they should not be covered in 188(1). So this was general theory about the related party definitions. Now, the application of these related parties transactions or the definitions in the IBC. So for especially as regards the avoidance transactions. So what we understand is one of the prime duties as RPs is to identify these PUFE transactions and try to see whether the CD has been subject to any of these transactions, so that we are able to take some remedial actions or try to bring back or plow in back that money which may have flowed out of the company on various due to various reasons. Now again, we know the look back period for transactions 1 year before the ICD, and in case of related party transactions 2 years before the ICD. So this becomes necessary that we identify who are related parties, so that the transactions what are entered into by the company with those entities, we can need to go back 1 more year in time. And if it's a fraudulent transaction or if it's a case falling under 66(1), then we can still go back and look at, there's no time limitation. So we can go back and look into transactions as far back as we want, being a fraud. Again, we know that the amendment which is coming in, which will make the 2 years before the, as rather than the ICD, they're taking it 2 years back before the filing of the application, which would be really helpful in actually determining whether something is, some transactions have actually taken place, because sometimes when the matters reach the NCLT, there is already a delay in that. So there, once that amendment comes in, I think we will be able to cover all those transactions also. Right now, we are required to restrict ourselves only to 1 or 2 years before the ICD only. Then certain observations of the Supreme Court in the Anuj Jain case. So in the IRP for JP Infratech versus Axis Bank. So key principles for identifying preferential transactions is what was discussed in that particular case. So the Supreme Court has distinguished section 43 of the IBC from sections 328 and 329 of the Companies Act, and observed that if the ingredients of 43 of IBC are satisfied, then the transaction is deemed to be a preferential transaction, notwithstanding the intent of the parties. So here they're saying you should not be going into the intent of the parties, but merely if the requirements of section 43 ABCD are satisfied, then the transaction must be categorized as a preferential transaction under 43. Now, the bare text of 43(3)(a) of the IBC stipulates that a transaction is exempt from being treated as a preferential transaction if it was carried out in the ordinary course of business or the financial affairs of the CD or the transferee. However, the Supreme Court has observed that a purposive interpretation of 43 demands that the phrase corporate debtor or the transferee should be interpreted as a corporate debtor and the transferee. In other words, the Supreme Court has observed that for a transaction not to be treated as a preferential transaction, such transaction is required to have been undertaken in the ordinary course of the business affairs of not only the transferee but also of the CD. So both the parties, for both the parties, it should be a transaction which is in the ordinary course of business. Then only it can fall outside the purview of 43. Otherwise, it has to be included in as a preferential transaction. Then the phrases ordinary course of business and financial affairs are not defined in the IBC. And some case law in Australia is there, in which was referred to by the Supreme Court, in which it was held that ordinary course of business means that the transaction must fall into place as part of the undistinguished common flow of business done, that it should form part of the ordinary course of business as carried on, calling for no remark and arising out of no special or particular situation. However, it is again relevant to note that the Supreme Court has not interpreted the meaning of the phrase financial affairs as regards section 43. Then for determining whether an alleged transaction entered into by the CD with its related party was in the ordinary course or not, the Supreme Court analyzed the unique nature of relationship between the CD and the related party for this particular case, and arrived at the conclusion that those transactions were indeed were not in the ordinary course and were preferential transactions. Look back period for preferential transaction is 1 year from the date of CRP, 1 year before the date of CRP. In relation to transactions with unrelated party, it is 1 year, and for related parties, it is 2 years. So this was just about the theory, what we or the some of the case laws on the ordinary course of business and those things. Now we can look at the provisions of the law. Okay, so now the next topic which we need to cover for today's discussion is the PUFE transactions or the transactions as especially as regards the related parties, and which are defined in the code as falling under the PUFE or the avoidance transactions. Now, for this purpose, understanding the concept of twilight zone is very important. So, twilight zone is the period of trading when the company has insufficient funds to pay its debts and is on the verge of insolvency. So this may be a case where the insolvency has not yet started, of course, but some period before that. So maybe the application may or may not have been filed with the NCLT, but this is the starting point of the period from the time when the director knew or ought to have known that there was a reasonable prospect of avoiding that there was no reasonable prospect of avoiding the insolvency. So very knew that for sure now maybe that this there's a default of the bank has sent notices and is on the verge of initiating the section 7. So then that is the point when the director knows that there is no way of avoiding this insolvency, but then it causes some additional responsibilities, or in this particular period the directors are supposed to have higher responsibilities or a duty to try to minimize the losses to the creditors and protect the assets of the company to the extent possible. So this is the rationale behind identifying this period as a twilight period. And in this period, there is a need that the director should be more diligent and more prudent and try to protect the assets so that at least further losses are not caused either to the financial creditors or to the operational creditors. So this identifying this twilight zone is very important when we are trying to identify these transactions. So sometimes it may be that the application got admitted after 2 years. So it was filed say in 18 and got admitted in 2020. So that entire 2-year period, we may categorize it as a twilight zone, because this is when the corporate debtor or the directors knew that this company is now on the verge of insolvency. There is no reasonable prospect of avoiding that insolvency. But now they need to be even more careful in handling the affairs of the company. So in one case where I was appointed as the IRP, that director, as soon as the application was filed and the company's business had started going down, and the matter was argued, it was section 7, so the matter was argued and it was reserved for orders. After being reserved for orders, actually the order came out after 4 months, but in that interim period, that director shifted all the entire machinery of the company to some other location. And that in turn led to there being no reasonable prospect of a resolution plan, because any resolution applicant who would come in thereafter would say that I first need to incur a lot of expense to first shift that machinery from that other location to the company's location and reinstall it. And that itself was, did not work out for the resolution plan. So this was a twilight period when that the director had a duty to be more diligent towards the activities and try to minimize the losses to the creditors, but which was something where he failed to do that. So this twilight period, we should be able to identify that twilight zone, and in which we should be able to cast more responsibility on the directors. Otherwise, we can always categorize this transaction as a wrongful trading transaction under section 66. Now we discuss this look back period to be 2 years before the date of filing instead of the CRP commencement date, but this is yet to see the light of the day, but it would definitely be a welcome change if it comes, because we will now be able to go 2 years just before maybe the default happened or those dates. So that will be more helpful for us. Now identifying the specified transactions. So the categories of transactions given are section 43, preferential transactions, undervalued transactions. Then 49 is the transactions of defrauding creditors, extortionate credit transactions, and fraudulent trading or wrongful trading transactions. So preferential transactions. This is just the bare text of the section, but the text of the section itself is relevant for understanding what all we can include as a preferential transaction. So let us go and read each and every item so that we understand what all transactions can be covered as preferential transactions. So 43(1) says where the liquidator or the RP. So here we understand that if not during the CRP stage, even during the liquidation stage, we can identify these transactions and file for necessary reliefs. So where the liquidator or the RP, as the case may be, is of the opinion that the CD has at a relevant time. So whenever that transaction was being entered into, given a preference in such transactions and in such manner as laid down in subsection 2, to any persons as referred to in subsection 4, he shall apply to the NCLT for avoidance of preferential transactions and for one or more orders under section 44. So this is the enabling provision. So we need to identify the persons who are given in subsection 4 and what is the manner of giving preference, which is given in subsection 2. Now subsection 2, a corporate debtor shall be deemed to have given preference if. Now all these conditions are and. So we need to show that each of these conditions has been satisfied, then only a particular transaction will be identified as a preferential transaction. There is a transfer of property or an interest thereof of the CD. So that property should be belonging to the CD. There should be a transfer of that property or of the interest in that property for the benefit of a creditor or a surety or a guarantor. So now the benefit should have flown either only to a creditor or a surety or to a guarantor for or on account of an antecedent financial debt or operational debt or other liabilities owed by the corporate debtor. So the essentials are that there should be a transfer of property or an interest in the property. That property should be belonging to the CD. The transfer should be for the benefit of a creditor or of a surety or a guarantor. And there should be an antecedent financial or operational debt of that particular party. So that person should be an existing creditor, and then he has got certain benefit from the company. And the transfer under clause A has the effect of putting that creditor or the surety or a guarantor in a beneficial position than it would have been in the event of a distribution of assets being made in accordance with section 53. So suppose under 53, he was entitled to get something only as a shareholder. So suppose the company has entered into a transaction with somebody who is a shareholder of the company, and that shareholder under section 53 would be at the end of the distribution table, as we know. But he being a creditor, he was also a creditor, and because of the nature of the transaction, his amount has gone up. So, or maybe his debt got categorized from an operational debt to a financial debt. Any of these transactions, so the can be categorized as a preferential transaction. If we see that this preference has been given, if we are able to show that the preference has been given to that particular shareholder who was an existing creditor of the company, and certain monies have been given to him additionally, because of which now he has become, his position in the distribution chart has improved as we see under section 53. Then we go to subsection 4. A preference shall be deemed to have been given at a relevant time if it is given to a related party. So any of the related parties under 524, other than by reason only of being an employee, during the period of 2 years before the ICD, or a preference is given to any person other than a related party during 1 year before the ICD. So these are the timelines. But we need to really concentrate on subsection 2 only. And when we are identifying, when we have some transaction before us, maybe we identify this A, B, C, D, E, all these points under A and B of subsection 2, and see whether each of these conditions has been is being satisfied. Then only we will be able to categorize a particular transaction as a preferential transaction. Otherwise, even if one of these conditions is not satisfied, then it may not be, we may not be able to show that it's a preferential transaction. So, then the definition of property. So where we have seen that there is a transfer of property or an interest in the property. What does property mean? Property includes money, goods, actionable claims, land, and every description of property situated in India or outside India, and every description of interest, including present or future or vested or contingent interest, arising out of or incidental to that particular property. So all of these things. So maybe somebody is a debtor, maybe debtors are being assigned, some money has been transferred, some funds are given as advance to the shareholder or to the director or that existing creditor, goods are given to that particular person. All these transactions will fall under the definition of this property. And then we are able to identify that this is an issue of, this is a transfer of property or an interest in that particular property. Now, exceptions, what will not form, what will not be considered as a preference. For the purposes of subsection 2, a preference shall not include the following transfers. So transfers which are made in the ordinary course of business, like we saw, and any transfer creating a security interest in the property acquired by the CD, to the extent that such, so anything which is given as a security, just before, on which some security interest is being created in that property. So just because that security interest is created in that property in the favor of a person who is an existing creditor, that only will not make it a preferential transaction. So again, we have to fit it into and ensure that it is exactly fitting into subsection 2, while also not falling under the exceptions of subsection 3. Now, what are the orders which we can ask for from the NCLT? Is that any property which has been transferred by way of such preference can be vested back in the corporate debtor, or any property to be so vested with the CD if it represents the application either of the proceeds of sale of property so transferred or of money transferred. So they can ask for that money to be taken back from that related party, or order for release or discharge in whole or in part of any security interest created by the corporate debtor. Order any person to pay such sums in respect of benefits received by him from the CD to the liquidator or to the RP as the NCLT may direct. Then against the orders which can be obtained against the guarantors are also specific. Then that orders can also be for providing security or charge on any property for the discharge of any financial debt or operational debt. And also it can also direct for providing the extent to which person is going to pay how much. And sometimes you can ask the directors also to bring in the money. So if one of the directors fails or if the others fail, then you can identify one person from whom that you can ask for that money to be transferred back to the company. So depending upon the facts of the case, depending upon the nature of transactions which you have identified as a preferential transaction, the orders, the prayers will have to be very specific. What is it that you are exactly asking? The first prayer should be that to categorize this transaction as preferential transactions. And the second order, second prayer would be what is it that you want from that under these clauses? What is exactly that you are looking for that the NCLT should direct? That money flow in that transaction be declared null and whatever it may be. Whatever is permissible under section 44 and which is relevant to that particular transaction which you are dealing with. Exceptions in the order. So that order under this section shall not affect any interest in the property which was acquired from a person other than the corporate debtor, or any interest derived from such interest and was acquired in good faith and for value. So these are exceptions when we are seeking orders. We will not be able to seek orders against these transactions. So again, that we have to be careful when we are drafting the prayers. Then order under this section shall not require a person who received a benefit from the preferential transaction in good faith and for value to pay a sum to the liquidator or to the RP. So maybe in this case, we may not be able to ask that whatever to get back the value from that third party, but whoever was the instrumental in entering into the transaction, say the director or the shareholders of the company, we can instead ask them to give that benefit back to the company. Certain common examples of preferential transactions. Payment of unsecured family loans during the look-back period while the debt of the secured creditors is outstanding. So instead of paying to the secured creditors or paying a smaller amount by paying a smaller amount to the secured creditors, the family loans of the family members, the unsecured loans of the family members are being paid back in the look-back period. Then payment of old operational creditors other than the regular business payments against supply of goods or services, while the debt of the secured creditors or the unsecured creditors are still outstanding. So the bank loan is still going on, but the old operational creditors dues are being paid in priority. Then the payment of secured debt against which the property of the directors is mortgaged would also be considered as a preferential transaction. Payment to a secured creditor in priority while the debt of other secured creditors is outstanding. So only paying the loan of only one creditor and not paying the other creditors. That can also be treated as a preferential transaction. Payment of personal loan to the director. Payment of salary to a director who does not work for the company. Awarding contracts to firms of director or the director's wives without any vendor selection process being in place. Payment to an unsecured financial creditor while the debt of the secured creditors is still outstanding. So here we see, the effect, what is there, that there is some payment happens from the company. So there is a transfer of property from the company and it goes to a person who is already a creditor of the company and who may be a related party if you look back for 2 years. And again, that person is now in a better position as in the hierarchy of section 53. So all these conditions are being satisfied in these examples. Payment to those creditors who have security of post-dated checks signed by the directors would also be considered as a preferential transaction, so that we can say that this payment is being done so that 138 cases are not filed against the directors. So with that intent, the payment is made to these creditors in priority. Adjustment of debit balances of debtors with credit balances of other parties. So would also be considered as assignment of debt to operational creditors who have much lower priority under section 53. So saying that this debtor will pay you directly. So adjustment of those debit balances of those debtors and creditors will again improve the position or improve the status of the operational creditors. Maybe if 100 was outstanding to them, now only 20 will be outstanding to them. So in that sense, it will we can still consider that as a betterment of their position in the distribution chart, and we can categorize it as a preferential transaction. Now, undervalued transaction, so which is under 45. Again, if the liquidator or the RP, as the case may be. So here, either during the CRP or during the liquidation, these transactions can be identified, and we can report those transactions to NCLT. On an examination of the transactions of the CD referred to in subsection 2, determines that certain transactions were made during the relevant period under section 46, which were undervalued, he shall make an application to the NCLT to declare such transactions as void and reverse the effect of such transaction in accordance with this chapter. So the prayer for undervalued is maybe only to get these transactions reversed and to get back the value what was given to the other party. Now, undervalued transaction, what is given in subsection 2? A transaction shall be considered undervalued whether CD makes a gift to another person. So of course, if it's a gift, then there is nothing which has come back to the CD. So it can be categorized as an undervalued transaction, or enters into a transaction with a person. So again, that person can be an individual, an entity, whichever nature, enters into a transaction with a person which involves the transfer of one or more assets by the CD for a consideration, the value of which is significantly less than the value of consideration provided by the CD, and such transaction has not taken place in the ordinary course of business of the CD. So here, all these again conditions need to be satisfied, that the transaction has been entered into with that particular person. This transaction involves a transfer of one or more assets by the CD for a consideration. So the value of that consideration is significantly less than the value of consideration provided by the CD. So let us look at some examples also for this. Now, under section 46, what we need to show is that in an application for awarding a transaction at undervalue, the liquidator or the RP shall demonstrate that such transaction was made with a person within the 1 year preceding the ICD, or in case of related party, 2 years preceding the ICD, And the NCLT may require an independent expert to assess evidence relating to the value of transactions mentioned in this section. So it might be advisable to have a third-party independent valuer's report to assess the value of the property in case the property is transferred at some lesser price. Then an independent valuer's report which will show that this transaction is an undervalued transaction, or what was the market value of that particular asset at that time. Where an undervalued transaction has taken place and the liquidator or the RP has not reported it to the adjudicating authority, a creditor, member, or partner of the CD can make that application to declare these transactions void and reverse their effect in accordance with this chapter. So if we fail in our duty, any creditor, member, or the partner of the CD can make a similar application. But in this case, this subsection 2 is dangerous, where the adjudicating authority, after examination of the application, is satisfied that the undervalued transactions had occurred, and the liquidator or the RP, after having sufficient information or opportunity to avail information of such transaction, did not report such transaction, it shall pass order restoring the position as it existed before such transactions and reversing the effects of those transactions, and requiring the IBBI to initiate disciplinary proceedings against the liquidator or the RP. So in case we fail in our duty to identify an undervalued transaction, then, and if somebody else does that, then this is the consequence of such under section 47 subsection 2. So we have to be very, very careful when we are reporting to IBBI that no such transaction was identified. Now, what are the orders which we can get against an undervalued transaction? Is that the order of the NCLT may provide for requiring the property transferred as under this transaction to be vested in the corporate debtor, release or discharge in whole or part any security interest granted by the corporate debtor on that asset, require any person to pay such sums in respect of benefits received by such person to the liquidator or the RP as the NCLT may direct, or to require the payment of such consideration for the transaction as may be determined by the independent expert. Say that land was transferred for 10 lakhs only, whereas when the value was 50 lakhs, then that difference amount as has been determined by that independent expert, the NCLT can direct that the balance amount be paid to the CD. Now, some common examples of undervalued transactions: giving loans or advances to related or unrelated parties without any business objective. Transfer of good friends. So suppose just this company has some money and that money is given to the group companies without any business objective, or there is no prospect of earning anything from that particular transaction to the CD. Transfer of good franchisees to another person at a value which is much lower than the actual value. Transfer of shares of subsidiary companies where the business is lucrative at a price which is less than the actual value. So here in most of these cases, you will have to have something which is there to identify what is the actual value. Maybe the valuation report can help, or you can appoint somebody only for the identifying the value of this particular transaction or the subject matter of this transaction. And then you will, because when you are filing your report to the NCLT, filing that application to the NCLT, you will have to support that with an independent auditor's report or an independent valuation report to show that yes, this is an undervalued transaction. So it might be helpful to have appoint a third part independent professional who will give that report. Writing off of sundry debtors or advances without justification or reasons or efforts to collect that amount. Then buying of shares of any associate concern for a value which is much higher than the actual inherent value of those shares. Buying dead assets of the family or associate concerns to keep the assets or money of the CD away from the creditors. So in one case, there was this particular company also had a partnership firm. I mean, the owners had a partnership firm. There was certain old obsolete assets, which were machinery, which was there in that company. The CD purchased that machinery from this company at a much higher price. And there was no valuation report which was there, but it was a used machinery, which maybe was there for 5-10 years. And the CD had paid some 40 lakh rupees for it. So then there we appointed an independent valuer to assess what was the value of those return. No, even the written down value was not maintained properly in the book. So we appointed a person who was able to value those assets, and from that we were able to identify, or we were able to prove that this particular transaction has taken place at a much the amount which was paid by the CD to that partnership firm was much more than the value of the assets which were coming in. So where we need to prove that the consideration being flown in is much less than the consideration which is going out from the CD. Other examples are selling of unsold inventory by real estate company before the CRP at a price which is less than the market value. Sale of inventory at lower value as compared to the actual value in other cases also. Purchase of any assets at very high value to keep the funds of the CD away from the creditors. Settlement of dues of associate concerns or other parties at a value which is much less than the due amount. So trying to give discounts to these parties. Then sale of fancy and expensive cars owned by the CD to related parties or unrelated parties at a value which is much less than the market value of the car. Then selling of fancy offices or any other valuable property of the CD to any related or unrelated party at a value which is much less than the market value. Transferring of intellectual property rights, software, patents, or digital assets to somebody who may be related or unrelated, but again at a price which is much less than the market value of these assets. So any of these examples, of course, these are some of the examples which we can use, and when we have a case in front of us, maybe see whether any of these transactions have actually taken place in that entity. Then we will be able to identify them as preferential, as undervalued. But again, mind you, for undervalued, we again need to restrict the time limit to 2 years in case of related party and 1 year in case of unrelated parties. Now, fraudulent transactions, transactions defrauding creditors, section 49. So the first limitation here is where the CD has entered into an undervalued transaction as defined in 45. So necessarily for a transaction to fit under 49, it has to first fit into 45. So unless the transaction is an undervalued transaction, you will not be able to say that this is a transaction which also falls into 49. So where the CD has entered into an undervalued transaction as referred to in subsection 2 of 45, and the NCLT is satisfied that such transaction was deliberately entered into by the CD for keeping the assets of the CD beyond the reach of any person who is entitled to make a claim against the CD, as in any creditor, or in order to adversely affect the interest of such person in relation to the claim. So again, adversely affect the interest of any creditors typically, then NCLT shall make an order restoring the position as it existed before such transaction, as if the transaction had not been entered into, and protecting the interest of the persons who are victim of such transactions. Provided, now there's a proviso here, provided that an order under this section shall not affect the interest in property which was acquired from a person other than the CD. The other similar kind of exceptions what we saw in this section 43 transactions. So whether the property was acquired in good faith for value without notice, and did not require any third party who has received a benefit in good faith to transfer back that money to the company unless he was a party to the transaction and unless he knew of the circumstances in which this transaction was being entered into. So these are the two exceptions. So we have to ensure that when we are trying to identify a transaction as a fraudulent transaction, then firstly it has to be an undervalued transaction, and then it is the transaction which is defrauding the creditors, and also that it does not fall into these exceptions. Then extortionate credit transaction, where the CD has been a party to an extortionate credit transaction involving the
Madam, we have been covered POFE separately and sessions, madam. You can avoid the provisions of the IBC in this forum, madam. You can rush through beyond that.
I have been asked to take this for 4 hours, sir. So I need to this thing. Maybe if you are not interested, if you have covered this, you can skip this part.
No, we are covered in the same session in the past few days.
In the directions which have been given as to the matters which I am supposed to cover, I have been asked to cover this.
Sir, let her do it. It is a flow that she is making. Please. Let us allow her.
Maybe you can ask the organizers why there is an overlap, not me.
No, ma'am, please continue. We are sorry for intervention.
Section 50 extortionate, where the corporate debtor has been a party to an extortionate credit transaction involving the receipt of financial or operational debt during the period within 2 years preceding the ICD. The liquidator or the RP, as the case may be, can make an application for avoidance of such transaction to the NCLT. if the terms of such transactions required exorbitant payments to be made by the CD. Now, going further in this, the board may specify the circumstances in which the transactions shall be covered under subsection 1. Again, there's an explanation here which talks about, for the purposes of this section, it is clarified that any debt extended by any person providing financial services which is in compliance with any law for the time being in force in relation to such debt shall in no event be considered as an extortionate credit transaction. So all the financial services transactions specified have been excluded from this purpose from the purview of section 50. What are the orders which can be obtained under section 51? So where the NCLT, after examining the application, is satisfied that the terms of the credit transaction required exorbitant payments to be made by the CD, it shall by an order restore the position as it existed prior to the transaction, set aside the whole or part of the debt created on account of the extortion credit transaction, modify the terms of the transaction, require any person who is or was a party to the transaction to repay that amount, or require any security interest that was created as a part of that credit transaction to be relinquished in favor of the liquidator or of the RP. Now, certain examples of extortionate credit transaction could be borrowing from employees, directors, or associate concerns at higher interest rates. Availing credit card loans at high interest rate is not an extortionate transaction because that is the terms of service as per the credit card company, whatever the transaction may be with the CD. Taking unsecured loans from parties at exorbitant interest rates and on unfavorable conditions. And while the CD is under financial stress, the supplier stipulating monopolistic terms to supply the goods on credit, that also can be a potential extortionate credit transaction, where some people say that unless they pay cash upfront, then these people will not be able to, those suppliers will not be able to supply goods to the CD. All those also can be termed as extortionate credit, because this is the time when the CD was already in problems. There were financial difficulties, and in that course, when somebody is trying to extort the money for their own interest, where the directors may have to borrow it from somebody else, from some relatives at say a very high interest rates, then all those transactions can be categorized as the extortionate credit transactions. Now, fraudulent trading. If again, this can be identified during the CRP or during the liquidation process. So if during the CRP or a liquidation process, it is found that any business of the CD has been carried on with the intent to defraud creditors of the CD or for any fraudulent purpose, the NCLT may, on an application of the RP, pass an order that any persons who were knowingly parties to the carrying on of the business in such manner shall be liable to make such contribution to the assets of the CD as it may deem fit. Now, fraudulent trading is kind of vague, where we need to be able to establish that the entire affairs of the CD were being carried out in a manner which was with the intent to defraud the creditors of the CD. So here, it is not only one particular transaction which we can identify, because that we need to do under 49 if it is an undervalued transaction, and also if it falls under 49. But here, in case of a fraudulent trading, we have to be able to establish that overall the business has been carried on in a manner that this the management has been trying to defraud the creditors of the CD or for any other fraudulent purpose. Like in one case where I was able to identify certain transactions as under 66(1), where a company had availed loans from various banks. So there was a loan of about 39 crores which was availed from a consortium, and out of that 39 crores, 38 crores were transferred to group companies back to back without that money being utilized for the CD at all. And the name, of course, that loan was in the name of the CD. The CD was servicing that loan, but the CD did not get a single rupee of benefit out of that loan, which was availed in the name of the CD. The assets of the CD were given as security for that particular loan, but the CD was not getting the benefits out of it. That entire money in the day it came into the CD, in the next 7 days, that money was transferred by way of different transactions to all the group companies, say towards investment in preference shares, investment in debentures, or for say purchase of some assets from the group companies, or leasing of certain assets which were available in the market. So directly the CD could have leased it from those from the open market. but this was routed through this group company, so that the group company leased those assets, and in back to back it leased to the CD. So there was a difference in prices, and it was obvious that this entire business or this entire loan transaction which was carried out was for the benefit of these group companies, and not only for the not at all for the benefit of the CD. So even though the CD was paying the loans, was paying the interest on those loans, it did not benefit from these particular transactions. So I have categorized these transactions as a case of fraudulent trading. Now I have filed my applications with the NCLT for the NCLT to decide. But the whole gamut of operations which took place in that particular CD, everything pointed out that entire 39 crores was wiped out by not utilizing it for the company. So in this, even the banks were defrauded because the amounts were not used for the purpose which was as per the sanction letter. The sanction letter said that it will be utilized for the purposes of this particular CD, but in fact it was utilized for investment in group entities, and from there it flew to the directors. So from those group companies, the directors have withdrawn that money towards their loans to directors or towards directors' salaries and so on. So eventually that money came back to the directors. So certain transactions, so for fraudulent trading, it may not be like only one-on-one transaction as such. We have to weave a story as to why we feel that this is a fraudulent, the business of the company itself is being carried on with the intent to defraud the creditors. So a number of transactions and a number of instances might fall into this. Then wrongful trading, 66(2), on an application made by the RP during the CRP. So again, if we see 66(2) is only during CRP. All other sections are we can invoke in the course of liquidation or in the course of CRP. But here we need to, this is only restricted to CRP process only. The NCLT may, by an order, direct that the director or partner of the CD, as the case may be, shall be liable to make such contribution to the assets of the CD as it may deem fit, if before the ICD, such partner or director knew or ought to have known that there was no reasonable prospect of avoiding the commencement of CRP for that CD, and such director or partner did not exercise the due diligence in minimizing the potential loss to the creditors. So here now again we come to the twilight zone, that concept which we discussed, where in the twilight zone, these directors and promoters have an added responsibility of acting in the interest of the company, trying to maximize the value, or at least not to create further losses to the creditors. And during that period, if they fail to do that duty, then it may be a case of wrongful trading. Now, what are the orders which we can get for with respect to applications under 66 and 1 and 2? Is that the NCLT can give further directions for giving effect to the order, and in particular the authority, the NCLT may provide for the liability of any person under the order to be a charge on any debt or obligation due from the CD on him, or on any mortgage or charge or any interest in the mortgage or charge on the assets of the company. So basically the kind of orders which we can get under 66 1 and 2 is any benefit which may have gone on to the third parties. Those third parties may be asked to restore that benefit, and in case they fail, then the directors can be made to make good those losses to the CD. Again, further, where the NCLT has passed an order under subsection 1 or 2 of 66 in relation to a person who is a creditor of the CD, it may by an order direct that the whole or any part of any debt owed by the CD to that person or any interest thereon shall rank in the order of priority of payment under 53 after all other debts owed by the corporate debtor. So even though that person who has got the benefit may be a financial creditor, still the NCLT can direct. Of course, we also have to add a prayer to that effect in the application. The NCLT can direct that that person will not be treated, his order of priority in case of distribution under 53 can be changed by orders of the NCLT in this for 66 1 and 2. So it has far-reaching consequences of trying to get back the money which was lost of the CD. Common examples: undervalue transactions with fraudulent intent causing loss to the security interest of the creditors for unknown gain to the management. Then lack of diligence while doing business during the twilight zone, which causes a loss to the CD. Then falsification of books of the accounts by making entries of bogus expenditure for diversion of funds of the CD for personal gains by the management. Falsification of books of accounts with the object of increase in the assets of the CD in the books of accounts to present a rosy picture to the banks for securing additional credit facilities.
Can we take a short break?
Sir, we are going to take a... Sir, can I request you not to interrupt me time and again? The break will be at 3 o'clock. If you want to log out, you can log out now. Let me finish my flow in this. And then if you have any questions, we can take it after that. Thank you. Siphoning of inventory or stock of the CD by showing increased consumption by falsification of books of accounts. Submission of fake financial statements to banks or financial institutions to secure additional credit facilities. So giving two balance sheets, one was used to be given to the banks and one used to be given in the ROC. Then the any transaction with the objective of keeping the asset or property of the corporate debtor away from the creditors. Manipulation in the books of accounts or other records of the CD to receive the creditors. Siphoning away funds of the CD by resorting to bogus transaction, causing loss in the books of accounts for personal gain of the management. Fraudulently removing the property of the CD, which will cause loss to the creditors. Using of forged documents and records to obtain sanction and disbursement of credit facilities, that is bogus sales bills, bill discounting, export and import bills. And falsification of accounts by recording fake transactions of sale and purchase for obtaining increased credit facilities from banks and FIs. So these were the common examples of these fraudulent or the PUFE transactions which we generally enter, which may have been entered into by the CD, and which we need to identify as a part of our duties as RP or the liquidator. So here we'll take a break, and I think let's get back at 3:10. 15 minutes good?
Sure, ma'am.
Yeah, so if we can assemble at 3:10 and continue with the rest of the things.
Thank you very much. बहुत डिस्टर्ब कर रहे हैं लेडी को सब लोग ऐसे ही
Ma'am, should we start?
Sure, ma'am.
Okay, so the other part which we have to cover today is just one second. Yeah. So the Phoenix ARC judgment with reference to the related parties. So this is regarding the section 21 of the Companies Act, of the IBC, pertaining to the constitution of the Committee of Creditors. Now we are aware that section 21 of the COC, of the IBC, which deals with COC, it says that the Committee of Creditors shall comprise of all financial creditors of the CD, provided that a related party to whom the CD owes a financial debt, that is a financial creditor, or the authorized representative of the financial creditor, referred to in subsection 6, 6A or subsection 5 of 24, if it is a related party of the CD, shall not have a right of representation, participation or voting in the meeting of the Committee of Creditors. So the law is fairly settled on this, that these Committee of Creditors will only comprise of the financial creditors who are independent, and the other financial creditors will not form part of the COC. They will not have any participation rights or voting rights in case they are related parties of the CD. Of course, this exception, that is the first proviso, shall not apply to a financial creditor who is regulated by a financial sector regulator. If it is a related party of the CD only by virtue of conversion of the account or the substitution of debt into equity shares, or any instruments which are convertible into equity shares, or completion of such transactions prior to the insolvency commencement date. So with that exception, anybody else who is a related party of the corporate debtor and who is a financial creditor will not be able to participate or vote in the meeting of the COC. Now, the landmark judgment on this was the Phoenix ARC case, which was decided by the Supreme Court. So let us look at the details of this particular case. So this case started as a Section 9 petition before the NCLT New Delhi bench of one Mr. Hari Kishan Sharma versus Acme Projects Limited for his outstanding salary debt of rupees 12.26 lakhs. So that time, as you know, the limit was only of 1 lakh rupees. And this application was admitted by the NCLT New Delhi bench. The CRP started in April 2018, and the IRP constituted the COC in May 2018. Now, claims were filed by the financial creditors, out of which there were 2 financial creditors, Spade Financial Services and AAA Landmark Private Limited, both of which filed their claims as the financial creditors of the CD Acme Projects. Now, these claims were rejected by the IRP on the grounds that these were not in the nature of financial debts. As regards Spade, the IRP said that the claim is not in the nature of a financial debt in terms of Section 5(8) of the IBC, since there was an absence of consideration for the time value of money, that the period of repayment of the claimed ICDs was not stipulated. AAA's claim was rejected on the ground that its claim as a financial creditor in Form C was filed after the expiry of the period for filing such a claim. On this decision of the IRP, both Spade and AAA filed applications before the NCLT challenging this rejection. Now, NCLT decided in favor of Spade and AAA and directed the IRP to consider their claims again as financial creditors. Now, against this decision of the NCLT, which asked the IRP to reconsider the claims, Phoenix ARC and Yes Bank, who were the other members of the COC, they objected to this particular inclusion of SPADE and AAA, and they filed an appeal against, they filed an application with the NCLT on the grounds that these are related parties of the CD. And these applications were filed by Phoenix ARC and Yes Bank sometime in 2018, which were finally decided in July 2019. Till that time, the COC constitution could not be concluded because there was a dispute about the constitution itself. The IRP could not go ahead and proceed with the finalization of the voting share and all those things. Now in July 2019, finally, the NCLT decided these two the applications filed by Phoenix ARC and Yes Bank on the inclusion of SPADE and AAA. Now the main contention by SPADE and AAA in these in the response to these applications was that in these entities, Mr. Arun Anand, now this is some family, Anand family, which was there, and he had a lot of transactions with all these group entities, out of which SPADE and AAA were all there were also a lot of transactions of the CD with SPADE and AAA. Now this Arun Anand, who was also a director with the CD, his and his family members, they had long ceased their association with the CD before the initiation of CRP. And the Arun Anand and his family members were also associated with SPADE and AAA on its board, and in the capacity of taking day-to-day decisions, policy decisions, and those things. So at that point in time, Arun Anand and SPADE were closely, and AAA were closely connected with each other. And along with that, CD was also connected because Arun Anand was also on the board of the CD. Now, long before the initiation of the CRP, Arun Anand and his family members, they stepped down from the board of the CD. And as such, now SPADE and AAA is claiming that as on the CRP commencement date, these are not related parties. So SPADE and AAA are not related parties. Hence, they are eligible to be financial creditors and participate in the COC. This contention was rejected by the NCLT in these applications, and NCLT held that SPADE and AAA were related parties under 524, and hence they could not be included in the COC. Now, the nature of transactions of the CD with SPADE. SPADE has given intercorporate deposits to the CD during the period 2009 to 2013. Now we see the CRP sometime in the period 2018-19, but these transactions are of the period 2009 to 2013. A net amount of 66 crores was given by SPADE to the corporate debtor, and MOUs were entered of 2011 August, which provided for a 24% interest. These ICDs were secured by providing security, namely 37 flats of which was being built by the CD, and certain other plots and those things, the details of which are given in the orders. Now, the charge was not registered with the ROC. Even though the ICDs were secured, the transactions between the parties said that it was a secure transaction, but the charge was not registered with the ROC. Out of the intercorporate deposits given by SPADE to the CD of 66 crores, 43 crores were credited to the account of Arun Anand by consent. So here SPADE as well as the corporate debtor agreed that out of the 66 crores being borrowed by the CD from SPADE, 43 crores will be transferred to the account of Arun Anand. So effectively, the CD got only the balance of, say, whatever 23 crores. Now, in addition to that, SPADE was hired as a consultant by the CD on assignment basis only during the period of 2009 to 2011, with a clear mandate that it would not constitute a partnership. So on paper, it was written that transactions between SPADE and the CD were only in the nature of some consultancy services. They would not constitute a partnership between the CD and SPADE. And the other transaction with SPADE was that the ICD of 66 crores was given to the CD. Now the transactions of the corporate debtor with AAA. The corporate debtor and AAA Landmark also executed several agreements for plot buyers agreements and development agreements ranging in the period of 2009 to 2012. There were certain development agreements also which were entered into between the two parties. And in terms of the development agreement of 2012, entered into by the CD with the AAA, 38% of the development rights in one particular project were sold by the CD to AAA for a certain amount. Subsequently, In 2012 also an agreement to sell was executed, which superseded the development agreement, prior one, with an enhanced value of 43 crores. So if you see, even the amount in both the transactions appears to be similar. And the price of this transaction, there was also a dispute, as in there was also questions raised about this, the price at which this the CD has sold this per square feet, whatever the plots and flats which were being sold by the CD. Now, in the applications which were filed before the NCLT and where the NCLT held that these are indeed related parties, the NCLT has made certain observations. So what it says, what is relevant here is that before parting with this application, we would like to observe that the affairs of the CD as well as the group of Arun Anand companies are deeply entangled, and it is difficult for the tribunal in a summary jurisdiction to unravel the same. Considering that the CD and Spade and AAA were in close business relationship in the past, and also the fact that the accounts of the CD have not been finalized and audited and filed with the ROC since 2016, we have no hesitation in allowing the instant applications filed by Yes Bank and Phoenix ARC. By saying this, both these applications of Yes Bank and Phoenix ARC were admitted, and these two parties were held as related parties, and hence they were not financial creditors who are allowed to participate in the COC. Now, appeal was filed by Spade and AAA to the NCLAT against this decision of the NCLT. The main contention by them was that these allegations are for a period of 5 years before the CIRP commencement, which would not even be relevant consideration for 43 and for identifying the POFE transactions, where the time limit is only 2 years, going back before the ICD. Now, NCLT upheld the decision of the NCLT and declared that Spade and AAA are related parties under 524F. That is, any body corporate whose board of directors, managing director or manager in the ordinary course of business acts on the advice, directions or instructions of a director, partner or manager of the CD. So under this particular clause, NCLAT held that these two were related parties. It also observed that during the transaction period of 2010 to 13, Spade was under Mr. Arun Anand, and it was making substantial financial arrangements on behalf of the CD by acting on the advice, instructions and directions of the director and management of the CD, who was Mr. Sohail Anand and Anil Anand. And thereby this case clearly falls under the provisions of 524F of the Insolvency Code. However, both of these, NCLAT held that both are financial creditors. Now, even though they said that they are related parties, but NCLAT held that both are financial creditors. Now, against this decision that these two are financial creditors, ARC filed an appeal in the Supreme Court saying that these are not FCs. And also Spade and AAA also filed appeal in the Supreme Court saying that against the finding that they are related parties. So both sides filed counter appeals there before the Supreme Court. Now the questions to be decided by the Supreme Court were whether Spade and AAA are indeed financial creditors of the CD, whether Spade and AAA are related parties of the CD, and whether Spade and AAA have to be excluded from the COC. Like if the answers to the first two questions will decide the answers to the last question. Yes, sorry. So the question whether Spade and AAA are financial creditors of the CD. Here the courts had to determine whether the corporate debtors board of directors, the directors individually and other members are accustomed to act on Arun Anand's advice, directions or instructions, and if he participated in the policy making process of the CD. While a strict determination of intent or mens rea may not always be possible by the NCLT and NCLAT in summary proceedings, it is possible to draw the inference from the facts and hands. This is what the Supreme Court has held while deciding the question whether the Spade and AAA are financial creditors of the corporate debtor. Now the facts are that there was a deep entanglement between the entities of Arun Anand, Anil Nanda, and Arun Anand did hold positions during this period, which could have been used by him to guide the affairs of the corporate debtor. So in all the group companies, whatever were there, he was holding substantial positions in and decision-making roles. This finding is further supported by our conclusion that the transactions between the CD and the entities led by Arun Anand were collusive in nature. Similarly, we have no hesitation in accepting the NCLAT's conclusion that Spade entered into two transactions on the basis of the advice, instructions, directions of the board or directors of the CD under section 524F. So it has concluded that the CD was acting on the instructions of this person, and hence it's a related party under 524F. While the transactions may have indeed been commercial, it cannot be doubted that Spade undertook them due to the pervasive influence of Anil Nanda. While in our analysis above, we have similarly come to the conclusion that other past transactions between these entities have also been collusive. Therefore, they concluded that Arun Anand, Spade, and AAA were related parties of the CD during the relevant period when the transactions took place, on the basis of which Spade and AAA are now filing their claims as financial creditors.
Madam, sorry to interrupt. Could you please tell whether this transaction where we would recover? Anyway, POFE, it will not cover the period, right? So could you please give that perspective also?
So here, since the transactions have been entered into prior to 2 years, they may not fall under the PUFE unless we are able to put them into the fraudulent transactions or under section 66. So where there is no look back period. Otherwise, it will fall outside the purview of the transaction audit.
Okay. So all this would be a futile efforts for all this period, only delaying the CARP, but we are not gaining actually out of this.
Not really. Here the constitution of the COC itself was not decided.
Okay, okay. Apart from that, we are not taking any gain on the POFE, can it be taken to the fraudulent, or was it taken to the fraudulent angle? Or
that
not?
Question was not decided in this case because this case is only pertaining to the inclusion of these parties in the COC or not.
In the COC, okay.
So the next question before the Supreme Court was whether Spade and AAA are related parties of the corporate debtor. Here the IBC recognizes that for the success of an insolvency regime, the real nature of the transaction has to be unearthed in order to prevent any person from taking undue benefits of its provision to the detriment of the rights of legitimate creditors. Now, in case these two parties are held as financial creditors and are allowed to sit on the COC, then their voting percentage would be considered, and they would have substantial say in the conduct of the CRP. Hence, it was very important to decide whether these parties are indeed related parties, and based on that, the constitution of the COC can be concluded. Now, what the Supreme Court says here is that the expression related party is defined in section 524 in relation to a corporate debtor. Now, 524A provides corresponding definition in relation to an individual. The definition describes a commutative relationship, meaning that X can be a related party of Y if either X is related to Y or Y is related to X. So both the transactions or both the relationships are covered there. The definition of related party under IBC is significantly broad. The intention of the legislature in adopting such a broad definition was to capture all kinds of interrelationships between the financial creditors and the corporate debtor. Now, the purpose of defining the term separately under different statutes is not to avoid inconsistency, but because the purpose of each term of them is different. For the context of each law, like we have seen the context for the Companies Act, the definition is different, and the context of the definition for IBC is different. So that is what they are discussing here in this para. Hence, while understanding the meaning of a related party in context of the IBC, it is important to keep in mind that it was defined to ensure that those entities which are related to the CD can be identified clearly, since their presence can often negatively affect the insolvency process. And these two were related parties during the relevant period, is what the Supreme Court has upheld. Now, the next question which arises for decision is whether Spade and AAA have to be excluded from the COC. So, having concluded that they are related parties, whether they should be excluded from the COC. Now, the controversy in the present case is on the interpretation of the phrase is. You know, in that 524F, or if we look at 524 itself, it says is a related party. So, the question to be decided is that is to be looked at what point in time. Where the contention of Spade and AAA was that they were in the past, they were related parties, but as of the insolvency commencement date, they both are not related parties. So that was the point to be discussed at how to interpret the phrase is. Now, these objects underscore the composition of the COC guided by section 21 of the IBC. Objects and purposes of the code are best served when the CRP is driven by external creditors, so as to ensure that the COC is not sabotaged by related parties of the CD. This is the intent behind the first proviso to 21(2), which disqualifies a financial creditor or the AR of the financial creditor under such and such section, if it is a related party of the CD, from having any right of representation, participation, or voting in the meeting of the COC. Since the IBC attempts to balance the interest of all the stakeholders, such that some stakeholders are not able to benefit at the expense of the others, related party financial creditors are disqualified from being represented, participating, or voting in the COC, so as to prevent them from controlling the COC to unfairly benefit the CD. So this would have been like a backdoor entry to the CD to decide the fate of the CRP if these two people were allowed to be sitting on the COC. Consequently, the first proviso to 21(2) was amended to extend the disqualification to the specified authorized representatives in case that these representatives happen to be related parties of the CD. The introduction of the phrase "is" along with the related party was not a guiding factor before the parliamentary amendment. So that the Supreme Court is trying to deal with the reasons why this amendment was brought in and how to interpret that amendment. The exclusion under the first proviso to 21(2) is related not to the debt itself, but the relationship existing between the related party financial creditor and the CD. As such, the financial creditor who in presentee is not a related party would not be debarred from being a member of the COC. However, in case where the related party financial creditor divests itself of its shareholding or ceases to become a related party in business capacity with the sole intention of participating in the COC and sabotaging this CRP by diluting the vote share of other creditors or otherwise, it would be in keeping with the object and purpose of the first proviso to 21(2) to consider the former related party creditor as one debarred under the first proviso. Hence, while the default rule under first proviso to 21(2) is that only those FCs that are related parties in presentee would be debarred from the COC, those related party FCs that cease to be the related parties in order to circumvent the exclusion under the first proviso of 21(2) should also be considered as being covered by the exclusion thereunder. So here it is, the Supreme Court has clearly underlined even the logic behind trying to exclude such related parties from the COC, even though they may not be related parties on the date of the CRP. To conclude, it is evident that there existed a deeply entangled relationship between SPADE, AAA, and the CD when the alleged financial debt arose. While their status as related parties may no longer stand, we are inclined to agree with Mr. Kaul that this was due to the commercial contrivances through which these entities seek to now enter the COC. The pervasive influence of Mr. Anil Nanda, that is the promoter director of the CD, over these entities is clear, and allowing them in the COC would definitely affect the other independent financial creditors. So saying in the this judgment, they have held that these financial creditors, these two parties are related parties, even though they may not be related party on the commencement of CRP, and hence they were debarred from participating in the COC. So this was about the provisions of 21A.
Can you show the previous slide once again, if you don't mind?
Yeah, sure. This one?
Yes, please.
Yeah.
Perfect. So, ma'am, in general, in this first paragraph, how will we assess that someone has done this with this intent?
So, like in this case, if you also read the NCLT judgment, the first one, in this case, and even the the Phoenix ARC judgment, there's a detailed discussion about the relationships between the parties. So I have not got into a lot of detail because that would be like, it's a 30-40 page kind of thing.
Okay.
But
no, because this is very important paragraph. That's why I brought.
Yeah.
You see that, however, in case where the related party financial credit divests with the sole intention of participating in the COC and sabotaging the CRP. Now, this is something, how will I as a RP determine every time? That's what I was thinking.
See, as RP, I think, we also have to see that it was the IRP in this case who first pointed out that these are related parties. So the material which he had on hand was the nature of transactions which were entered into between the parties, all the agreements which were there with the parties, and the fact that no balance sheets were filed after 2016. So he went into the relationship between the parties before 2016. And the nature of transactions, the organization chart for each of these entities. So that has been discussed in detail in the Supreme Court judgment, what all facts were considered when this conclusion was arrived at. So it is a very interesting read to understand, it was such a web of transactions that we had to actually, I mean, the RP would have definitely sat and categorized each of those transactions along with the parties, because even the family members were, there were cross holdings between the parties. Then the family members were directors and shareholders in all of those entities. And eventually, he may have concluded that giving them or not identifying them as financial creditors at this stage would give them a backdoor entry on the COC. So he may have started with that intent, and eventually more and more facts would have come before when the matter moved on to the NCLAT or to the Supreme Court. But the RP would have had only these kind of the basic information in front of him, based on which he concluded that these are related parties and should not be allowed to sit on the COC. So whether they were trying to sabotage and all is a conclusion that if they sit on the COC, then they will get unfair rights. And of course, there was Yes Bank and Phoenix ARC who were there, who would have provided certain further information also.
Can I ask an unrelated question, ma'am? Not
yes,
entirely
yeah,
to
yeah.
this.
Yeah.
And if you feel this is unrelated, you can drop it, please.
Yeah,
so
no, please go ahead.
I'm an RP in one company where there were 3 family directors.
Yes.
Before the CRP, one of the directors resigned. Now the 2 directors are saying that he was the director who has resigned was actually running the operations.
Yeah.
So he has all the knowledge, while he has run away in the sense is not contactable.
Yeah.
Isn't the same thing that he is trying to derail the CRP process? But what can I do against such a director?
If he was still a director, or if we are able to file under 19.2, but 19.2 is actually in that sense, we hardly get any relief in that, because we file the application, nothing happens, and it goes on for months together. So maybe you can look at other provisions in the code which are there. If he's a director or a shareholder, and if he's bound to provide certain information to you, there are certain other obligations under section 70 or other sections, whereby those people are, you can file an application under that section, and then it mandates that that information needs to be provided to you. So there are certain clauses, those provisions which we regularly don't use, which talk about any other criminal action which can be initiated. So sections after 66 and those sections, around 70s, we generally don't use those sections. But some of those sections definitely have to make these directors answerable, or so provide information wherever we are not able to get the information even after 19.2.
You said 17 and
70. So after 70, we can, those sections will follow, which talk about punishment for not giving information, or punishment for doing something wrong, or something about the books of accounts. Certain data is not kept properly, and all those, or the where they have been given instructions to the employees of the CD not to pass on the information to the RP. So section 70 subsection 3, and then we have these other things, fraudulent about non-cooperation. Of course, 19.2 doesn't have much teeth, but these other provisions are there which can be utilized.
Thank you.
Yeah. See, so something like 71, which talks about punishment for falsification of books, then material or willful omissions from statements relating to the CD. All these sections are there which we don't generally use, but these are something which can be used either through the special courts or through the NCLT.
Okay, thank you.
Okay, is 29A covered by any other session, or should we cover that? Ma'am? Because 29A is also relevant to the related party topics and decisions on who can be included. So is anyone else covering that in any of your other sessions, or should I cover that?
No, ma'am, no one is covering. You can take it up.
Yes, so 29A, very, very important section, what we utilize it in the course of checking who is a related party or who is eligible under section this, I mean, for the filing of submission of EOI, for submission of resolution plans and so on. This section is also relevant in case of liquidation when we are trying to sell the assets of the CD. So we have to ensure that we are selling it only to somebody who is eligible to purchase those under 29A. So 29A, what we are covering here is the involvement of a related party, and under 29A. Why was 29A brought in with a retrospective effect and certain case laws? So this 29A was inserted in the IBC through the ordinance of 2017, and it was brought into effect with, from 23rd November 2017. The preamble of this ordinance of 2017 says that in order to strengthen further the insolvency resolution process, it has been considered necessary to provide for prohibition of certain persons from submitting a resolution plan who, on account of their antecedents, may adversely impact the credibility of the processes under the code, and that it is also considered necessary to make provisions to specify certain additional requirements for submission and consideration of the plan before its approval by the committee of creditors. So the first filter, I would say, and then this amendment was brought in retrospectively. Before the amendment, every individual could participate in the bidding process of the CD, irrespective of their connection with the corporate debtor. This could have led to the corporate debtor again going back to fraudulent people who were actually responsible for the insolvency. So they in themselves could bid for the company, and they could acquire the company under the resolution plan, get rid of the liabilities, and again take back control of the CD. Disqualification of all those individuals and entities that have actually contributed towards the downfall of the CD through their fraudulent motives and are related parties or connected persons of the corporate debtor. So to disqualify all of these people, it was necessary that that amendment be brought in, and be brought in with a retrospective effect. 29A constructively facilitates corporate governance, as it prudently suppresses the promoters to buy back the SIC entity at subsidized rates and also free from any of its past liabilities. And we need to understand that the resolution plan not only helps the creditors, but also the SIC entity, which is on the verge of liquidation. So ensuring that it goes in the correct hands. If a person who has already contributed to the downfall of the CD, if the company goes back to him, then it will again be a futile exercise. That entire that insolvency exercise may be considered to be futile. Now 29A, it talks about the persons not eligible to be a resolution applicant. And it gives certain categories of people who are not considered to be eligible. So a person shall not be eligible to submit a resolution plan if such person or any other person acting jointly or in concert with such person. Now it talks not only about that particular applicant, but any person who is acting jointly or in concert also with that applicant. That person will also not be eligible to be a resolution applicant. So first, who is an undischarged insolvent, is a willful defaulter in accordance with the RBI guidelines. Now I'm not going into the details of who is a willful defaulter. Then at the time of submission of the resolution plan, has an account or an account of the CD under the management or control of such person, or of whom such person is a promoter, is classified as a non-performing asset in accordance with the RBI guidelines or the guidelines for financial sector regulator issued under any other law for the time being in force, and at least a period of 1 year has elapsed from the date of such classification till the date of commencement of CRP. So to understand this subsections clause 6, at the time of submission of resolution plan, now this is also relevant, it need not be on the date of commencement of CRP, we have to see on the date of submission of the resolution plan. So not even at the EOI stage, at the submission of the resolution plan, who has an account. So such person, if he has an account or an account of the CD under his management or control, or of whom such person is a promoter. So if that person is a promoter and that account has been declared NPA under the RBI guidelines, and at least a period of 1 year has elapsed from the date of such classification till the commencement of CRP, then that person will not be eligible to be a resolution applicant, provided that the person shall be eligible to submit a resolution plan if he makes payment of all the overdue amounts with the interest thereon and whatever charges may be related to the NPA before submission of the resolution plan, and provided further that nothing in this clause shall apply to a resolution applicant where such applicant is a financial entity and is not a related party of the CD. Now, if that person, if this entity which is there, which is only, it is a financial entity as defined under the code and is not a related party, then this clause will not apply. And for the purpose of this proviso, who is a related party? So the related party shall not include a financial entity regulated by a financial sector regulator if it is a financial creditor of the CD and is a related party of the CD solely on account of conversion or substitution of debt into equity shares or any other instrument into equity shares before the which has been completed before the insolvency commencement date. So some equity shareholder who is now holding equity, but he had say some convertible securities like debentures or any other convertible instrument which got converted into equity before the ICD only by virtue of the terms of the loan. So in such a case, such person will not be termed as a related party for the purpose of this section. The second explanation is that where a resolution applicant has an account or an account of the CD and all, which is a non-performing asset. So if his account has become NPA and this account was acquired pursuant to a prior resolution plan, which he took by way of a resolution plan under this code. So any resolution applicant of any other third CD, but who has now acquired that other CD and the account of that particular CD is a non-performing asset, then he will not be debarred only by virtue of having acquired that particular CD under this under that resolution plan. Then any person who has been convicted for any offense punishable with imprisonment for 2 years or more under any act specified in the 12th schedule or for 7 years or more under any other law. Now, this clause will not apply after the expiry of 2 years from the date of release. So it is not a perpetual disqualification, only up to 2 years from the date of release from imprisonment. And this clause will not apply in relation to a connected person who is defined in the explanation 1. Now, there are certain acts which are given in 12th schedule. And there are for those acts only 2 years or more imprisonment is relevant, and for any other act 7 years or more is relevant. So this is just a list of the acts in the 12th schedule. So generally all of Foreign Trade Act, the RBI Act, the Essential Commodities, SCRA Income Tax Act, Customs Act, the Pollution Control Act, the COFEPOSA, then SICA, Environment Protection Act, Benami Property Acts, SEBI, FEMA, Competition Act, Companies Act, LLP Act, FCRA, all those acts are covered. So anybody who has been convicted under these acts for a period of 2 years or more will be disqualified. Next disqualification is if such a person is disqualified to act as a director under the Companies Act. Now, if a person is disqualified under the Companies Act, then he will not be eligible to become a resolution applicant. And this clause will not apply in relation to a connected person under explanation 1. Next disqualification is if the SEBI has prohibited such a person from trading in securities or accessing the securities market. Then in this case also, this person will not be eligible to act as a resolution applicant. This person has been a promoter or in the management or control of a CD in which a PUFE transaction has taken place, and also in respect of which the order has been made by the NCLT. So merely as the RP finding out the transaction is not relevant, the NCLT order should also have been made on that upholding that particular transaction. Again, this clause will not apply to a resolution applicant who has acquired a company and in which company that such transactions had been identified during the course of CRP. So this resolution applicant will not be barred for holding such a company. Now, the next category is persons who have executed a guarantee in favor of a creditor in respect of the CD against which an application for CRP has been against which an application for insolvency resolution made by such creditor has been admitted under this code, and such guarantee has been invoked by the creditor and it remains unpaid either in full or in part. So a guarantor whose guarantee has been invoked and that guarantee remains unpaid. Then next is subject to any disability corresponding to clauses A or H above under any other law in a jurisdiction outside India. So now somebody who is similar disabilities under any law in any place outside India then also these he will be debarred or he will not be eligible to act as a resolution applicant. And any person who has a connected person who is not eligible under A2I. So even the connected person, the connected person is also separately defined. But that connected person also, if he is not eligible under A2I, even this person will also attract that disability. Now the explanation and the meaning of connected persons under explanation 5 for the purpose of 29A. Any person who is a promoter or management or in the management or in control of the resolution applicant, or any person who shall be the promoter or in management or control of the business of the CD during implementation of the resolution plan, or holding subsidiary, associate company, or a related party of a person referred to in 1 and 2 above. So all of these people will be termed as connected persons, and they also have to satisfy the criteria of A to I, and then only they will be eligible to submit a resolution plan. Of course, the exception is for the financial entity and somebody who is not a related party. Again, the same definition for that related party is where he becomes a shareholder or he becomes a related party by virtue of conversion of any convertible securities into equity shares. And the definition of financial entity has also been given. So, so if it falls under this, again, this person will fall under the exception. Now, why 29A is important, as we understand, is when we're checking the EOI, this we cannot allow a person who is a resolution to be a resolution applicant, somebody who does not fit under 29A or who is not eligible under 29A. Now, for identifying who all are covered under 29A as RPs, we have very limited means of maybe finding out all of those categories or finding out this the answers to all of those categories. Typically, what we can do is maybe once we have the DIN number of that person, we are able to go to the MCA website and find out which all other companies he is a director of. Or if we are able to get the MBP1 DRAs or his disclosures, then we may be able to understand the other parties in which he's, which are his related parties. Then doing a general Google search, a desktop search, writing his name, writing the name of his companies, and we get a lot of information on these Google pages about what all activities he has done, or whether any of these cases have been filed against him. So just a basic desktop search also helps us to identify whether he's debarred anywhere. Then we have the specialized agencies who undertake this search for us. So for a nominal fee, not depends upon the size of the CD also, but for a nominal fee and depending upon how many transactions each of these parties has entered into, or each of these resolution applicants has the number of related parties, the fees are decided by these agencies. So for each applicant, and they will identify who are the related parties, and for each of those parties they will charge. For further investigation into each of those parties, they will charge the fees. But these are CRP fees when we are doing it with the approval of the COC. So will get covered under the CRP cost. But it makes sense to appoint these agencies because there are some certain information which we may not be able to find out. Even maybe by looking at the RBI website or looking at the SEBI website, we may get some prima facie information, but for certain other kind of disqualifications, like if they're disqualified under the foreign jurisdictions, or what are the cases which are filed against them, if they're debarred under any of those cases, or in different civil courts or district courts and those things, we may not be able to get that much information readily. So it makes sense to appoint these agencies and get a detailed report from them. They give a very, very detailed drill down report for each entity and for each applicant and each of the related parties for each of those applicants. So it becomes easy for us to place that before the COC to be able to conclude whether this person is a resolution applicant or is an eligible resolution applicant or not. Now, when we are discussing this, 240A, the exemption to MSME is very relevant because two clauses of section 29A will not apply to a resolution applicant in the CRP or the pre-packaged insolvency, or if in case the CD is a MSME. Now here also the CD should be a MSME before the commencement of CRP. It should be a registered MSME, not only qualifying in the criteria. They should have a MSME registration certificate, then only that CD will be termed as a MSME, and then the two disqualifications in clause number 6 and clause number H will not apply. So everything else in 29A still applies. Only these two clauses will not apply. Now let us just quickly look at what these two clauses are. C is where the account is the NPA. At the time of submission of resolution plan has an NPA account. So in for the CDs which are MSMEs, this criteria will this particular disqualification will not apply, so that the promoters of the CD themselves can can be eligible to file a resolution plan. And then we have clause number H, which is about the guarantee clause. So in case of guarantors, so typically for MSMEs, we'll see that the directors and the promoters of this of the entity are the guarantors, and the guarantee is invoked against them, which is of course remaining unpaid. So again, to enable the MSMEs, to give them one more chance, this clause number H is also made not applicable, so that under 29A, C and H are not applicable in case of MSMEs under 240A.
We have taken special approval of the NCLT in a particular case where willful defaulter was forced on the MSME, and we were able to break that and get the benefit to the promoters to participate back again.
Right. So that is the intention, that where 29A, C and H will not be applicable there. Now the references to section 29A in the code, where all the references are there. Apart from deciding the eligibility of the resolution applicant, and section 30 also refers to, where all section 29A has been referred in the code. So section 30, which talks about submission of a resolution plan. So resolution applicant may submit a plan along with the affidavit that is eligible under section 29A. So that, of course, it is the onus is on the applicant to prove that he is not disqualified under 29A, but it is also our duty to check that he is actually, whether he is eligible or not under 29A. So it is one of the duties of the RP to check the 29A eligibility. Then again in the ordinance, it says that provided that the committee of creditors shall not approve a resolution plan submitted before the ICD, the Insolvency and Bankruptcy Code Amendment Ordinance of 2017, where the applicant is ineligible under 29A and may require the RP to invite fresh plan where no other plan is available. So this is with reference to the retrospective amendment which was brought in by the 2017 Amendment Act. And as we are aware that this amendment of that, the introduction of 29A itself was made with a retrospective effect. That is the pending, it was applicable to the pending CRPs also. And in cases where there were pending CRPs and there was no resolution plan, or if certain resolution plan was before the COC, then the period of 30 days was also given to the resolution applicant to prove or to show that he is not eligible under 29A. That he is eligible under 29A. So this was with the, again, the intent what we saw was where only the eligible persons should be allowed to file resolution plans in respect of the CD. Other reference in 29A is in section 35 of the code, which talks about the powers and duties of the liquidator. So which says, subject to the directions of the NCLT, the liquidator shall have the following powers and duties, namely subject to section 52. Of course, if it's a section 52, then the onus goes on to the banks, that is a secured creditor. But if we are selling it under liquidation, then the liquidator shall sell the movable and movable property and actionable claims of the CD in liquidation by public auction or private contract, with power to transfer such property to any person or body corporate, or to sell the same in the parcels in such manner as may be specified. So we'll refer to the schedule. Provided that the liquidator shall not sell the property to any person who is not eligible to be a resolution applicant. So again, we need to check the eligibility of the potential buyer also with reference to section 29A. Now in 54A, which relates to the pre-packaged insolvency resolution, again here the resolution plan submission, the person, the applicant should be eligible under 29A. Under the CRP regulations, invitation for expression of interest, the reference is there in the regulation 36A, where the expression of interest or the detailed EOI what we prepare, that should state the ineligibility norms under 29A to the extent applicable for the prospective resolution applicant. So 29A, of course, we know that entirely it will be applicable. And also in addition to that, any other ineligibility norms which the COC may decide. Then the expression of interest, when it is being submitted by the potential applicant, then they need to submit an undertaking that the potential applicant does not suffer from the ineligibility under 29A to whatever extent it may be applicable. So in case it's MSME, C and H will not apply. Further, the in sub-regulation 8 of 36A, it says that the RP shall conduct due diligence based on the material on record in order to satisfy that the PRA complies with the applicable provisions of 29A. So it is a duty cast upon us as the resolution professionals to conduct the due diligence based on whatever material is available on record to ensure that the potential applicant is eligible under 29A. Regulation 39, which talks about approval of the resolution plan. So in that it says that a prospective applicant in the final list of the applicants, the final list which we prepare, may submit a plan or plans prepared in accordance with the code and these regulations to the resolution professional electronically within the time given and all that, along with an affidavit stating that it is eligible to under section 29A to submit the plan. So again, the onus here goes back to the resolution applicant to say that he is eligible under 29A. Then in the form H, which is the compliance certificate, which we submit along with the resolution plans to the NCLT for the approval, is where we are saying as the RP that I hereby certify that the resolution applicant so and so has submitted an affidavit pursuant to 31 of the code confirming its eligibility under 29A of the code to submit a plan. The contents of the said affidavit are in order. Now, even though here we are saying that the applicant has submitted an affidavit, the last words which say that the contents of the said affidavit are in order. What do you interpret in that? Are in order means what? We have verified the contents of that affidavit, or we have independently verified that whatever is said in that affidavit about his related parties or everything is completely correct. So here we are trying to maybe just agree to what has been stated in the affidavit after doing our own due diligence, because if we look at all the provisions together, the duty is cast upon us to do that independent check. And here we are saying that this particular person is the contents of the affidavit are in order. So which means that we should have done our due diligence, and we are also certifying here that the person is eligible to submit a resolution plan. Other references in the liquidation regulations, in regulation 29A, which talk about compromise and arrangement. The regulation 2B of the liquidation regulations, which talks about the compromise and arrangement. So that compromise and arrangement cannot be with a person who is not eligible to submit a resolution plan. Then again in regulation 37, where the secured creditor is realizing his security interest, where he can sell it only to a person who is eligible under 29A. Then there is another section, another regulation 37A, NRRA, which talks about the not readily realizable assets. So during the course of liquidation, if we are not able to sell the assets, if there's some asset which is not readily realizable, then in that case, we need to sell that asset through a transparent mechanism, say by auction or by any other method, which is in consultation with the stakeholders committee. But again, there when we are selling it, the person who is taking over those NRRs should be a person who is eligible to submit a resolution plan. That means that he is eligible under 29A.
Madam, can you take a question, madam?
Yes, sir.
So in the previous slide, if you go back, you are saying compromise and arrangements. Where is the RP involved in this, madam? Most of the time we are, they are going to go off track and execute it, madam.
This is for liquidation regulation. So in the course of liquidation, when somebody comes with the proposal for compromise or arrangement, it is the liquidator's duty to take that to the NCLT to file an application.
Not during the course. So that time financial creditors are excluded from the purview.
Yeah. Now the role of the resolution professional with reference to 29A is of course examining the expression of interest, determining the eligibility of applicants under section 25 as well as 29A. So whatever eligibility criteria are decided by the COC, we have to ensure that the applicants are adhering to those as well as to 29A. Conducting the due diligence of applicants to check the compliance with 29A. Appointing outside agencies for the due diligence if required, if we feel that it's a complicated case and we are not able to find out, we may not be able to only rely on a desktop search, then it is better to appoint an outside agency and get a third party certified report on which we can rely. Of course, we will do our own due diligence to whatever extent is possible for us. But apart from that, like in one case which I'm handling, there we appointed this third-party agency, but they missed out on one case, which was a group company, and against that group company, certain SARFAESI proceedings had been initiated. We came across that notice in one of the newspapers, but they had missed that. So then we were able to give those inputs to the agency, and then they were able to include that case and the details of that case in their report also. So it has to be a joint exercise, so that for the ultimately the responsibility lies on us as the RP to ensure that no ineligible person is taken as the resolution applicant, or at least we need to place that before the COC that this person, according to you, is not eligible under 29A. And this comes from a recent decision where the Supreme Court has held that it is not the duty of the RP to decide the eligibility, or he cannot declare somebody as ineligible. He only has to place his opinion before the COC, and it is the COC's call to decide whether this person is a resolution, is eligible or not. So the wording in that particular decision, and we will be discussing that case, is the RP is not to take a decision regarding the ineligibility of the applicant. It has only to form its opinion, because it is the duty of the RP to find out as to whether the plan is in compliance with the provisions of the code or not. The RP can give his opinion with regard to each plan placed before the COC, and it is for the COC to take a decision as to whether the plan is to be approved or not. Now, this goes somewhere, where what we have understood is where it is the RP's duty to decide the eligibility. But based on this decision, now it appears that even though in your opinion, you may feel that a particular applicant is not eligible, you have to place your opinion before the COC and let the COC take a call whether this person is going to be deemed to be eligible under 29A or not. So this was about 29A. Now we have some time left only to discuss the case laws. Yeah, so these are some of the cases on related parties, and I also have some cases on 29A. So if we don't finish it, or if you don't want to discuss it here, then I can circulate these files and you can go through them. Let us see the cases on the related parties. So some cases decided by the NCLAT, by the NCLT, or by the Supreme Court on the related party. So an assignee shall be a related party under IBC if the assigner was a related party at the time of assignment. So in this case, the question to be discussed or decided was if the assigner at the time of assignment was a related party, then whether the assignee also is tainted by the same thing. So it was held by the NCLAT that yes, the assignee will also be held to be a related party if the assigner at the time of giving of that loan was a related party. Now this question of managerial personnel being interchanged between the companies. So in this case, it was held that the interchange of managerial personnel between various legal entities inter se without any association with the CD is not a valid basis to hold that such parties fall under the category of the related party of the CD, though they may be belonging to the same group. So this was in this case of Bank of India versus Naren Sheth of Jai Bharat Textiles and Real Estate. So based on the facts of this case, it was held that these are not related parties. So again, we saw that the particular clause, we have to really go into the facts of the case to be able to determine whether these two are related parties, whether the managerial personnel are being exchanged between them, and whether they are being utilized and on whose instructions they are acting. So accordingly, in this case, based on the facts, it was held that they are not related parties. Then the third case is the CD entered into a tripartite agreement with a related party between the CRP admission order reserve date and the pronunciation date. So this is in total violation of section 66. So like the case law, my case which I discussed, the date when the case was reserved for orders by the NCLT and the actual passing of the order, between that period, the CD has done something which is against the interest of the company. and which is detrimental to the interest of the creditors also. In this case, this was also held that this is in violation of section 66. So again, reference to the twilight zone and the duties of the directors in the twilight zone. So here it was held that this is falls under section 66. So in this case, the company had entered into a tripartite agreement during this particular period. Then this is an old case where it was the question was whether the secured financial creditor, while opting out of the process under 52, is debarred from selling the assets to the promoters. So now this question has been laid to rest because now the amendment was brought in 2020. But before that, the NCLAT has held that they cannot sell it to somebody who is ineligible under 29A. In this particular case of NCLAT, the fifth one, the appellate, now the facts of the case were discussed in Srimati K. Bharti and Kotak Mahindra Bank, where it was held that the appellant, being the mother of the managing director's wife, it fell within the meaning of related party under 524A, so which is related party in relation to a person or an individual. So based on the facts, there were questions whether these parties are related parties or not, and since the mother was held to be a related party, those entities were also held to be related parties and accordingly not eligible. Now, section 21, so the Phoenix ARC judgment, which we saw, another case on that. Section 21 relates to the COC, which normally is comprising of the FCs of the CD, but does not allow the related parties who owes the financial debt. So related parties cannot be included on the COC. NCLAT Delhi, can assignee of the related party be a member of the committee of creditors? So this case also we discussed that assignee, if the related party, the original creditor was a related party, then this loan also gets tented, this debt also gets tented. Then in this case, also discussed the eighth one, related party in the matter of Asan Global Trade versus Vasudevan. It discussed the related party under 524H, in which a related party in relation to a CD. We find that the related party is any person on whose advice, directions, or instructions a director, partner, or manager of the CD is accustomed to act. And this provision cannot be made applicable in relation to the second respondent, who is also FC. And in agreement referred to above, he is not supposed to give any advice and so on. So he was held to be that this other respondent was not held to be a related party. Now, SIA infrastructure versus Canara Bank. Now, again, in this case, the RP has refused the appellant to sit on the COC as a related party, and this decision has been challenged by in the NCLAT. So the loan of 440 crores was given by the CD, to the CD, and this person the loan was to be converted into equity, at the end of which they were going to get the voting powers. So the RP held that this person is a shareholder having more than 20% share in, and hence the entity becomes a related party. And on the basis of whatever documents, the RP had arrived at this conclusion. This decision was challenged, and the NCLAT held that these instruments have not yet been converted into voting rights. So as on the date, that entity does not have any voting rights exceeding 20%. They are still the creditors. So they were held not to be a related party, and they were allowed to sit on the COC in that particular case. Now this point number, the 10th one is the CRP cannot be initiated on a sham transaction entered between the related parties. So it's a Zoom versus Par Excellence Real Estate Private Limited. It's a New Delhi bench 2 decision. Recent decision of 2022, in which the applicant was an operational creditor and he filed an application under section 9 against Par Excellence, and certain points were brought to the notice of the NCLT, which show that this was a sham transaction between the two, and this was only this application has been filed with a fraudulent intent to defraud the other creditors of the CD and to take advantage of the process. Now we know that section 65 subsection 1 and 2 are there for the CRP, fraudulent initiation of CRP or for voluntary liquidation. And after holding this under 65(1), the NCLT has held that this is liable for punishment under 65(1). And this application was dismissed, and a cost of 2 lakhs was imposed on the applicant to be deposited by the applicant company with the PM relief fund. for fraudulent initiation of the CRP. Now the 10th is where if there's a common source of control over both the entities, it cannot be denied that the two entities become associated for that reason. So based on the facts of this case, it was concluded that there is a common source of control for both the entities, and hence these two become related parties. Now the question in this particular case was whether the debt claimed by the appellants can be considered as a financial debt under 5(8). So based, the facts were similar to something in the Phoenix ARC about the debt being given, and the claim of the appellants that they should be treated as financial creditors and be allowed to sit on the COC and participate in the COC. So the NCLAT held that it may be worthwhile, NCLAT referred to the Phoenix ARC judgment in this, and gave the final decision. Also, some other cases were also referred to, that is the Amrit Kumar Agarwal and Tempo versus Tempo Appliances and all that. And based on this, it was held, it held that considering the facts of the case and the provisions of the code and the judgments, we are not in a position to treat the money brought in as financial debt. The basic element of financial debt that such disbursement should be for consideration of time value of money, which was not directly evident here. Admittedly, the appellants have brought in 17 crores. However, it will not automatically fall in the definition of debt, and more so financial debt in relation to the CD. Since it cannot be classified as financial debt, the appellants cannot be treated as financial creditors. Therefore, the RP's reason as discussed above to not include the claims of appellants in the plan as financial debt, and also due to the fact that the appellant being a related party, which has been confirmed by the NCLT in the impugned order, is found to be correct. So this was upheld in that case. Now the questions which were discussed was whether the NCLT's order was incorrect, holding these as related parties in the code. So something similar to what we saw in the Phoenix ARC judgment. So here at the end, they have said that they are related parties under 524M, common control, and interchange of personal participation and all those things were held in this particular case. So this case may be a reference if you want to see what all cases can fall under this common control thing. And so we can read the facts of that case. And based on this, it has held that the appellants were indeed related parties, and there is no error in judgment in the NCLT order. Now, the next question was again the resolution plan, whether it was approved correctly and all those things, and whether they are related parties or not. So ultimately, they have said that the tribunal does not find any error in the order of approving the resolution plan. So those orders were also challenged. So for our purposes, maybe 524M, any case under 524M, that is relevant. Then one more thing which is relevant to us, where even though they are related parties, is that a copy of the resolution plan should be provided to the director of the CD. So even though the the directors are related parties and not entitled to participate and vote in the meetings, but they are entitled to seek to get a copy of the resolution plan. The final plan should be submitted to them. And this is referred to in 31(1) and all those other regulations which are referred to in this particular judgment.
The object, according to you, is that they get eligible if they want to challenge anywhere in the resolution plan. They can challenge it.
That is one. That is one, and then they have got so much of interest in the corporate debtor, so that they are entitled. They have been, they have been managing the corporate debtor. Their personal guarantees also may be involved. So they have a right, as a principle of natural justice, they have a right to get a copy of the resolution plan. Now, in this particular case of GS Constro versus Infra, which is a fairly recent case of 2022, the main issue which arose was whether the appellants here fall within the definition of related parties and whether their claims are financial debts. So most of the litigation, what we can see is based on this, whether somebody is a financial creditor and whether consequently they can be included on the COC. So again, the definition, this case law refers to the Phoenix ARC judgment, also discusses about the related parties and what are the disqualifications as regards to the related parties. So here in this case, the various facts were laid before this NCLT.
Madam, this segment you can take it a bit slow, madam. We are observing. If you can take it slow,
Okay,
because you've
sure.
got time, some more time is available. Take it slow, madam.
So you want to read this?
Yeah, just go through. You are going in perfect flow, but little bit slow. You are like a bullet train, slightly slow.
So in this case, it is what was held that the appellants together hold about 48% of the company. And the main contention of the appellants was that the master data of the CD was not updated on the MCA, and that they were never directors of the company. They were only the additional directors, which by virtue of the definition itself, they got disqualified, or they ceased since the AGM. The appointment was only up to the AGM date. And 161, the AGM was never conducted, so they ceased to be directors on the date when the AGM should have been held by virtue of the provisions of 161. Now, the Supreme Court judgment of Phoenix ARC was also referred, and the paragraph 62 and 63 of that particular judgment were referred here, which talks about the interrelationship. So if X is related to Y and Y is also said to be related to X, those observations which we saw of the Supreme Court in the Phoenix ARC judgment. And related party, it also referred that the related party has been defined by the Parliament in the Companies Act. So we have seen the definition of in the Companies Act also. And for listed entities, we have seen that the definition is already given in the listing agreement and the SEBI ODR guidelines. Also, the accounting standards are relevant there. However, in the present case, we are assessing the definition only under IBC, which is exhaustive. The purpose of defining the term separately under different statutes is to not to avoid inconsistency, but the purpose is different. So this also we saw in the Phoenix ARC judgment, where they are trying to restrict the usage or restrict the meaning or the connotation with respect only to the IBC. Then a brief perusal of the master data of the CD reflects the fact that the appellants 2 and 3 continue to be directors. So maybe the forms were not filed, but since the AGM was not held, their case is that they have ceased to be the directors. However, that did not get reflected on the master data. It is also seen that the second appellant, Mr. So-and-so, is the common director of the CD as well as the present appellant number 1 company. In application number so-and-so filed by the appellants herein seeking intervention in the Section 7 petition filed by the SEBI, it is submitted that they have acquired 44% stake. So there was some other litigation also which was going on between the parties, and the two appellants here who are claiming that they are not related parties, they have done these various other actions which the NCLAT has taken cognizance of, and has held that by virtue of these actions which have been taken by these two appellants, they are held to be the related parties. So here in the Section 7 petition, which was the initiating petition, this was filed by SEBI, and in which these two appellants seem to have filed an application in which they have submitted that they have acquired 44% shareholding of the CD. So which means that they themselves are the shareholders of the company, and by virtue of that, they are the related parties. And it is significant to mention that a copy of the master data of the CD company was annexed to that application there to prove that they have a locus standi for intervention. So now they were blowing hot and cold, which was not allowed. And once you claim that you are the directors or the shareholders of the CD, you become the related party. So therefore, they have said that the contention of the appellants herein that they were not directors of the CD company is untenable. Therefore, any financial creditor shall not have a right of representation, participation, and voting in the meeting of the COC if it is a related party. So which is decided, based on the Phoenix judgment that is decided. So in this case, it was held that these two are indeed related parties by way of their own submissions, which they have made before the NCLT in different proceedings. So they are held to be related parties, and accordingly, they cannot be now allowed to take advantage of the fact and try to come on the CD, on the COC.
Madam, here one question.
Yeah.
This most of the time, this SBI caps and all these capital businesses, they hold the shares also, or even Citibank. Most of this funding that has happened, they're holding the shares also, or kept the shares under pledge.
Yeah.
What is the status of them vis-a-vis a related party definition, madam?
So if the shares are only kept as pledge, then that those pledge shares are not transferred to the banks.
What about the shares which they also participate in the management? In those cases, what will be the
in that case
situation?
also this has been held, right? That where they are saying that if it's only by virtue of conversion of some loan into equity or by way of terms of the loan agreement, then they will not be held to be related parties. That provision is there in the code. As
well, which is the provision, madam? We just missed maybe in the if you had already
in the financial sector
represented
regulator. Yeah, in section 29A where we discuss that, there they talk about it.
Okay. There is any established case laws, or it is a plain interpretation of the statute?
It's plain interpretation of the statute.
Plain. Okay.
Yeah. Okay, just let us look at these cases on 29A. Yeah, so these are certain case laws on 29A. 29A, this is about the retrospective applicability of 29A, and whereby it was said that those who submitted the resolution plan prior to the set date, and if they were covered by 29AC, are entitled to derive the benefit of the second proviso of 30 subsection 4. So the question which arose was if the on the basis of the information memorandum, the expression of interest is submitted by the resolution applicants prior to 23rd November, that is the date of the ordinance, and then whether they are eligible to take advantage of the second proviso to subsection 4, that is which held that in case of so second proviso which said that they can be eligible by paying that money, and even though the account was NP and all that, they can be eligible by paying that money before the submission of the resolution plan, whether they can be allowed to take advantage of that. So it was held that therefore we hold that the expression of interest is part of the resolution plan which follows the resolution plan. In such a case, the date of submission of the expression of interest should be treated to be the date of submission of the resolution plan. So in this case, the question was what should be the relevant date which needs to be considered. Except in the manner the resolution applicants can make it eligible and get rid of eligibility under 29AC is only by making payment of all the overdue amounts in accordance with 29AC. So the clause which talks about if they are able to make that overdue payment within 1 month or before submission of the resolution plan, then they can be eligible under 29A, but in no other case they can. There is no mechanism which is provided to make an ineligible person eligible. So under any other clause. So just by selling the shares or the shares which are held in the CD, by selling those shares or transferring those shares now and getting that account, trying to get that account out of NPA cannot be a ground or cannot make them eligible under 29A.
This ArcelorMittal case is the example, no, madam, in SR Steel, that they had to clear their situation and come back.
Yeah. Yeah, I'm not very well versed with the facts of this case, but yes. Then the date of NPA classification is declared as relevant, or the date with effect from which the such classification is made to be effective is relevant for 29AC. So this is a NCLAT judgment which is arising out of the Kolkata bench order. This appeal was filed, this is a recent judgment of 2022. So here the question which was being discussed was which is the date to be taken as relevant. So the date on which the NPA classification is declared, or the date from with effect from which such classification is made to be effective. So which date should be considered here? So here it is held that the date of NPA classification by Canara Bank shall be treated as so and so, and it cannot be taken as 1/4/2009, which is the back date. It has been given by the Canara Bank, with effect from which the NPA is declared. So 2018 was taken as the relevant NPA classification date, and accordingly all other dates would be relevant from this date. Then the next case is of Pingley Builders, where in NCLAT, where after CRP was initiated, the promoter director cannot suppress from the IRP or the RP and apply for the MSME certificate to tide over the ineligibility. So in this case, previously the company was not an MSME or was not registered under MSME, but after initiation of the CRP, the directors themselves went ahead behind the back of the RP to get themselves registered as MSME. and then tried to take advantage by being eligible under section 29A. So here the RP has held them that they were ineligible, against which an appeal was filed. And the NCLAT also held that they cannot go behind the back of the IRP or the RP, make an application for obtaining the MSME certificate, and then try to take advantage of 29A. Then this is a case under 230 for compromise and arrangement under the Companies Act. So if a promoter, if he is ineligible under 29A, then of course he cannot make an application for compromise and arrangement under the provisions of the code also. So in this case, the NCLT had in fact gone ahead and allowed the application and issued directions for convening the meeting of the shareholders and creditors, against which the appeal was filed, and the NCLT has reversed the decision and allowed the appeal by the other applicant, by the other resolution applicant. Now, who are the competent authorities to decide the ineligibility of the resolution applicant under 29A or 32A? Now, this is very relevant for us as resolution professionals. In this decision, the NCLAT has held that has discussed the provisions which show that the following persons' authorities are empowered to decide whether an applicant is ineligible under 29A. So, who are eligible is the resolution professional in terms of 31 to find out whether such statement has been made or not. So, they are saying that the role of the RP is to determine whether such a statement has been made or not, that this person is eligible. Then the COC is empowered to decide whether the applicant is ineligible in terms of section 29A. Thereby, the committee of creditors is also required to decide whether it is a related party of the CD or not. Then the next person who is eligible to decide is the NCLT, where the NCLT, while passing that order under 31, can find out whether the applicant fulfills the conditions under 32, which also includes 32E, and in terms of 29A, the NCLT can decide whether the applicant is a related party or to the CD or not. Then secured financial creditor, yeah, we saw this case where the law was amended after this. Then in the JR Agro Industries case, I mean, in this particular case of JR Agro Industries versus the RP of Swadesh Oil Mills, it was held that JR Agro Industries is disqualified under clause E, read with clause G of 29A, on the ground that so and so was a connected person of JR Agro Industries is also disqualified to act as a director. Now, this person, we saw the definition in 29A where this person is a related party. He was a connected person, and he was also disqualified, being a connected person to this particular case and being disqualified under under the Companies Act. He was held to be disqualified under 29A, J clause number J, read with clause number E, to submit a resolution plan here. Then the next case law is where a merely retention of 2 of the directors of the CD does not violate any of the provisions of 29A. So in which case only 2 directors were there, which were common directors, and these directors were of the CD who were employees. They were always open to the resolution applicant to allow them to continue as employees, but not as directors. And these were anyway the operational creditors of the company. So the question here was about whether the resolution applicant is eligible. I mean, this particular resolution applicant is eligible under 29A or not. So merely retaining these 2 persons as directors of the CD does not make them ineligible. They are not related parties of the CD. Now, the 9th one again is relevant for us, whether the RP is competent to adjudicate upon the eligibility of the successful applicant under 29AF of the code, on asking of the whistleblower whether the RP has already submitted the resolution plan for approval of committee. So in this particular case, what was held was the resolution applicant shall not be eligible to submit a resolution plan if it is prohibited by SEBI from trading in securities or accessing the securities market. But the question which arose was how will on what basis has the RP decided that this person is not eligible? So various facts were discussed in this particular case, and the fact that this particular person is not eligible to under the SEBI guidelines. I mean, the SEBI had declared him not eligible to be trading in the securities. This fact was available on the website of SEBI, is what was found out, and the resolution professional has failed in his duty to go and check it from the SEBI website. So while discussing the role of the RP, what these cases is that it is a bounded duty of the RP to scrutinize the plan furnished by numerous applicants is complete in all respects before presenting it to the COC. RP is not required to take any decision, but he is to confirm that the plan does not violate any of the provisions of the law for the time being in force, including section 29 of the code. It means that the said information was in public domain. So the information about this particular person being barred by SEBI from trading, so that information was in public domain, and it was incumbent upon the RP before submitting the plan to the committee that a resolution applicant was eligible under 29A of the code as per its affidavit filed along with the plan. There is no averment and evidence placed on record on behalf of the RP that before submitting the plan to the committee of creditors for approval, he has verified the antecedents of the applicants from the websites of the SEBI and BSE. If SBI has accessed this information from the BSE website, then certainly the RP could also have done so if he had acted diligently. In these circumstances, it can be safely concluded that the RP has failed to discharge his duties diligently about verifying the eligibility of the resolution applicant. So see the remarks which are there. So in case we feel that we are not sufficiently equipped to look at or to find out this information, it is always better to appoint a third-party agency which will do all these checks for us, so that at least we have the complete information when we are placing it before the COC. So further, this says that when the matter
was very reasonable cost also, madam. It is also at a very reasonable cost, even if COC in most of the case they are not giving money. It is even from our pocket we need to spend and use it, madam.
It makes sense to rather than having such comments being passed in the orders, it makes sense to spend that money out of our own pockets also if required. So here then what was decided, what was discussed was whether the matter be referred back to the COC for determining the question of eligibility, or this bench may decide the eligibility of the applicant and reject the plan submitted by the applicant as being ineligible under 29A. So this question was also dealt with in the other case of JSW Steel, which we just saw. Here, it was discussed that who all can decide whether a person is eligible or not. Was the RP only to the extent of finding out whether the statement is made, then the COC, and then the NCLT. So from this, it was concluded that the NCLT is empowered to decide the eligibility of a resolution applicant and then accordingly take a decision on that. So again, going further, what the resolution professional had done in this case was that when he filed that application saying that this person is not eligible, he had made a prayer to the effect that take action against the resolution applicant for filing false affidavit under section 31 of the code, stating compliance of that of under section 29A, and that the performance security should be forfeited. The EMD should also be forfeited, and a direction against the respondents to deposit back the EMD of 15 lakhs, imposing a penalty of 2 crores under 235A, direction for prosecution against the respondents, and all those things. So all those prayers had been made by the resolution applicant, by the resolution professional against the RA. So here what the bench has said that if the RP himself has failed in his duty, then it is not proper for him to take all these information, to ask for all these prayers, because all these actions can be initiated against him also, since he had access to that particular information. So based on this prayer was not allowed, and no other action was also taken, but this particular, this applicant was held to be ineligible. Yeah. Now, this particular case law of Bank of Baroda versus MBL Infrastructure is about the retrospective effect, why it was brought. So it was this was decided by the Supreme Court under section RBL Bank had filed an application under section 7, which was initiated, then the plans were received, and then once the amendment came in, it went back about the personal guarantees and about who all will be applicable and eligible to submit the resolution plan. So the question which was to be decided was about the date of reckoning qua the provisions, that is the date of submission of the plan or the date of adjudication by the authority. So here it is held that it is clear that if there is a bar at the time of submission of resolution plan by a resolution applicant, it is obviously not maintainable. However, if the submission of the plan is maintainable at the time at which it is filed, and thereafter by operation of law, a son becomes ineligible, which continues either till the time of approval by the COC or adjudication by the authority, then the subsequent amended provision would govern the question of eligibility of the applicant to submit a resolution plan. The resolution applicant has no role except to facilitate the process. If there is ineligibility, which in turn prohibits the other stakeholders to proceed further, and the amendment being in the nature of providing a better process, and that too in the interest of the creditors and the debtor, the same is required to be followed as against the provision that stood at an earlier point of time. Thus, a mere filing of the submission of the plan has got no rationale, as it does not create any right in favor of the facilitator, nor it can be extinguished. One cannot say what is good today cannot be applied merely because an applicant was eligible to submit a plan at an earlier point of time. It is only a part of procedural law. So this further discusses about whether he is eligible and on that particular date or not, then about the execution of the personal guarantees which were invoked by the financial creditors, and at what point in time it will get attracted. So here what the Supreme Court has said is that the adjudicating authority and the appellate tribunal were not right in rejecting the contentions of the appellant on the ground that the earlier appeals have been withdrawn without liberty. The issue co-eligibility cannot be raised for a second time. So admittedly, the appellant was not a party to the decision and the adjudicating authority on the first occasion. And the appellant, the appellant merely filed an application for impleadment. So the question was never decided on merits as regards the eligibility of that particular applicant. And so on, they said that this resolution applicant, accordingly, it was held that they were not eligible under 29A. However, in this case, by the time the matter reached the Supreme Court, the resolution plan was already approved, the resolution plan was implemented, and the Supreme Court has taken note of this. So here in this paragraph, what they have said is that we need to take note of the interest of over 23,000 shareholders and thousands of employees of the R1. Now about 300 crores has also been approved by the shareholders to be raised by R1. So in this case, also 63 crores had been infused into the respondent one to make it functional. There are many ongoing projects of public importance undertaken by the R1 in the nature of construction activities, which are at different stages. So what they say after this is interesting. We remind ourselves of the ultimate object of the code, which is to put the corporate debtor back on the rails. Incidentally, we also note that no prejudice would be caused to the dissenting creditors, as their interest would otherwise be secured by the plan itself, which permits them to get back the liquidation value of their respective credit limits. Thus, on the peculiar facts of the case, we do not wish to disturb the resolution plan leading to the ongoing operation of the R1, and the appeal is disposed of. But they have specifically made it clear that this is applicable only to this particular case, and it should not be treated as a norm for other cases. Now, this next case is where again the question which was discussed was who has the power to consider the eligibility or ineligibility of the applicants under 29A. So here again it was held that the COC has the powers to consider the eligibility or ineligibility under 29A, where the main grievance of the appellant was that the COC did not have the power to consider that, where it was overturned, and the NCLAT has observed that the COC does have the powers to take that decision. Then the 12th one, section 29A of IBC, which referred to as undischarged insolvent, is applicable to individuals and partnership firms. So the question as to where it is going to be applicable, that question was decided as regards the undischarged insolvent. Now it was held that the undischarged insolvent is not defined in the IBC. However, the word insolvent has been defined in section 79, subsection 3, which falls in part 3 of the code. And the said part is applicable to individuals and to partnership firms. As per the above section, bankrupt means so and so. And therefore, from the plain reading of the above provisions, the undischarged insolvent is applicable to individuals and partnership firms. Now, this judgment is a bit I would say, it doesn't help or take us anywhere, because I would say that this is a very limited interpretation which is done. But I mean, it may mean that a person who has been held as insolvent under any other law may not be treated as undischarged insolvent for 29AA. So we need to wait for more decisions on this particular point. Now the expression control under 29A, so this was discussed in this particular case. This case law discusses that this expression control in section 29AC symbolizes only the positive control. That is, the mere power to block special resolutions of a company cannot amount to control. So just because you are holding certain number of shares and you have the power to block the special resolutions by virtue of the agreement or by the articles, that doesn't mean that you have the control of control as envisaged in 29AC of the code. Then the 14th one, if the corporate debtor is an MSME, it is not necessary for the promoters to compete with other resolution applicants to regain control. So whereby those two clauses were held to be not applicable, are said to be not applicable under 29A to the MSMEs, so that the MSMEs get one more chance to take back the company by filing a resolution plan. So the NCLT had held that the resolution plan was dismissed. I mean, they were held to be ineligible, but in the appeal, it was held that though being an MSME, the CD need not compete with the other resolution applicants and is eligible to bid for its own company. Again, 15 is the same, whether RP can take a decision regarding the ineligibility of the resolution applicant. Again, it is held that no, the RP is not to take a decision regarding the ineligibility of the applicant. It has only to form the opinion, because it is only the duty to form the opinion and place the resolution plans before the COC. Now, the 16th, where the NCLT replaced the resolution professional. Now this is like a contrary thing, again, so we need to be really careful. The NCLAT replaced the resolution professional who failed to examine the resolution plan as required under section 31, read with section 32, and an ineligible person was supported in the face of documents to the contrary. So now this was held, it was went into NCLAT, and the NCLAT decision now is in the Supreme Court. The Supreme Court has issued the notice and has stayed the operation of this judgment. The final decision has not come in this case. But the facts of this is that the NCLT approved the resolution plan, against which approval the appeal was filed. Now the NCLAT has remitted back the case to the NCLT and passed the following orders: that the impugned order approving the plan was set aside. The plan is rejected and it was submitted by a person hit by 29A. All actions taken in implementation of the plan which were approved by the order of so and so are declared as null and void, as the approved plan contravenes 30 subsection 2. Matter is remitted back to the NCLT, and NCLT is requested to pass orders for liquidation under section 33 of the IBC. Then further it has said that since the earlier RP has failed to examine the plan as required under 31, read with section 30 subsection 2, and an ineligible person was supported in the face of documents to the contrary, he shall be replaced and another appropriate RP shall be appointed as a liquidator under section 34(4). And costs were also imposed on the respondents, and they were directed to deposit those costs to the Prime Minister's Relief Fund. Then the next case is Shweta Shirke versus Committee of Creditors, so the NCLAT decision, in which case the application under 12A, which is the withdrawal. So that application under 12A of the code was filed at the instance of the promoter, approved with more than 90% of the voting share of the COC. But it was rejected by the NCLT Mumbai on the ground that the promoter was not eligible to file the plan under 29A, and hence he cannot file a withdrawal application under 12A. So the question which arose for consideration in this appeal, so this decision of the NCLT was appealed before the NCLAT, and the question which arose for consideration in the appeals was whether 29A of the code is applicable to the applicant if he intends to withdraw the petition under 7 or 9, if the Committee of Creditors has approved that proposal with a 90% voting share as is required under 12A. So here it is said that if a person, including the promoter or director, is ineligible in terms of any one or more clauses of 29A, he is not entitled to file a resolution plan either individually or jointly or in concert with another person. Insofar as 12A is concerned, it relates to the withdrawal of application by the applicant. So the promoters are not concerned, or they cannot be applicants here in that case. From section 12A and the decision of the Supreme Court in Swiss Ribbons, it is clear that the promoters and shareholders are entitled to settle the matter in terms of 12A. And in such case, it is always open to the applicant to withdraw the application under section 9 on the basis of which the CRP was initiated. In view of the aforesaid provisions, the NCLAT has held that 29A is not applicable for entertaining, considering an application under 12A, as the applicants are not entitled to file application under 29A as the resolution applicant. The application is being filed for withdrawal of the action which was initiated under section 7 or 9. So that was the cases under 29A. And the cases under for related parties. I'll be circulating this material to the ICSI. I think they will be circulating it to all of you. Now, in case anybody has any comments to make or add any points, please feel free.
That question I have asked you, madam, since I don't want to distribute. Can the penalty for slips by RPR IPE be claimed under professional insurance?
When did you ask this question?
I posted it.
No, somehow I'm not able to see the chat at all. I don't see anything in the chat. Okay, maybe you can just mention I mean, if you can just read that out. I can't see the chat.
No, can we, can the professionals take the shelter under professional insurance, this kind of slips?
So usually professional insurance, they will pay you only in case you are not found guilty. Generally.
Then why do we need insurance? These are all slips which
we don't. We just pay the premium. I mean that may be, you know, it may just in case you are held to be not guilty, it will cover your litigation cost.
Okay.
Yeah, it will not. If you are held guilty, if some fine is imposed, then it doesn't help us. So it is assuming that you are correct, and then only you are defending yourself.
There are so many provisions, and across globe we need to search it. We may always slip in terms of the resolution plan, but most of the time we are not going up to that itself. It takes years before that.
Yeah, or it goes into the liquidation directly.
Absolutely.
Right. So I think we are just a little bit before time. So if there are no further questions, I'm sorry, I'm not able to see the chat box at all. So if somebody has typed a question, I request or any observation also, you can just read it out maybe. I can.
Ma'am, there is no other question in the chat box.
Any reason why I can't see the chat box?
Ma'am, there is one option in the next to end the meeting. There's one more option. You can click there and the option of chat appears there. First option.
No, I can see chat at the bottom.
But there are no questions other than what I posted, ma'am. There are no questions for you.
Thank you. What I'm asking is that there is a chat I can see here, but then I don't see the chat box. That's
Ma'am,
anyway, some technical error. I don't know.
Yes.
Right. So thank you, and thank you for this opportunity, and thanks everyone for a patient listening. 4 hours is a very long time to speak and to listen both. Thank you.
Thank you so much, ma'am, for this wonderful, elaborate, and detailed session. A lot, and thanks to all the participants.
Thank you.
Thank you.
Bye. Good evening.
Good evening.